The Value Investors. Lessons from the World's Top Fund Managers. By Ronald Chon and Bruce C. Greenwald. Audiobook presented by the Learner's Library. Chapter 5, A Journey to the Center of Value. A. Valley of Tears. B. The Inefficient Market. C. The Meaning of Value. D. The Courage to Say No. E. Seeking Protection. Chapter 6, The Self-Taught Value Spaniard. A. On a Solo Value Hunt. B. Investing Made Simple. C. Austrian Economics and the Market. D. A Global Rebalancing. Chapter 7, The Income-Conscious Englishman. A. A Victorian Mindset. B. Finding the Right Investment Culture. C. Trusting Only Tangible Income. D. The Courage to Keep Going. Chapter 8, The Frequent Value Traveler. A. Reading Between the Minds. B. Thinking Big and Small. C. Trouble is Opportunity. D. Feeling the Market. Chapter 9, The Value-Oriented Businessman. A. Learning the Numbers. B. The Art of Contrary Thinking. C. Targeting Good Businesses in Asia. D. The Relativity of Valuation. E. A Value Lifestyle. Chapter 5. A Journey to the Center of Value. Jean-Marie Evelard. First Eagle Funds. If you would be a real seeker after truth, it is necessary that at least once in your life you doubt, as far as possible, all things. René Descartes. Jean-Marie Evelard is a French-born value investor who managed the First Eagle Global Fund, originally known as the Sogen International Fund, from 1979 to 2004. Over his 26 years of portfolio management, he generated an investment return of 4,393.08%, or 15.76% annually. During the same period, the Global Funds Benchmark Index, the MSCI World Index, returned 1,514.25%, or 1.29% per annum. In addition to First Eagle's notable global fund, Evelard also managed the firm's overseas and gold funds from their inception in 1993 until his retirement in 2004. The Overseas Fund, which invests in equities outside of the United States, returned 357.58%, or 14.36% per annum. Its benchmark index, MSCI EAFE, returned 83.54%, or 5.5% annually, during the same period. Evelard is highly respected in the investment industry, and his achievements were formally recognized by Morningstar in 2001 when he received its International Manager of the Year award. In 2003, he was one of 2 recipients of the organization's Fund Manager Lifetime Achievement Award. According to Morningstar, the award recognizes mutual fund managers who throughout their careers have delivered outstanding long-term performance, aligned their interests with shareholders, demonstrated the courage to differ from consensus, and shown the ability to adapt to changes in the industry. Now semi-retired and living mainly in New York, Evelard serves as senior advisor to and member of the Board of Trustees of First Eagle Funds and as senior vice president of First Eagle Investment Management, LLC. Jean-Marie Evelard confessed that he experienced 17 years of frustration before being able to practice value investing. After graduating from École de Hautes Études Commerciales, an esteemed French institution for the study of business, he joined Société Générale in 1962 as an analyst. At first, he was told to analyze stocks the growth way, and it was not until 1979 that he was able to convince his boss to let him do so in the value way. Evelard began his story. When I first became an analyst in the 1960s, security analysis was a new concept in France and in continental Europe as a whole. Before that, it had been a matter of insider trading, stock tips, and rumors. By security analysis, I don't mean the Benjamin Graham approach. Instead, it was based more on the latest investment trend in the US, which was growth investing. The concept was to look for hot and momentum stocks rather than valuing their true business worth. Before continuing, Evelard stressed that a value investment is one that sells below its intrinsic value. In searching for such an investment, growth is always part of the calculation. The trouble is that the investment world has divided value and growth into two different camps, complicating the very essence of security analysis. To minimize confusion, he said he would nevertheless discuss value and growth as separate concepts to make his arguments easier to follow. He resumed his story. After 6 years at Société Générale, I became bored, and I thought of doing something else because I found growth investing unsuited to my style. I told my boss about it, and he asked me if I wanted to spend a few years in New York City to do something different. Being single, I said yes, so in 1968 I moved to the US. While the work environment was different, I was still told to analyze stocks the growth way, so in the end my job was the same. During his next 6 years as liaison between the bank's New York City and Paris offices, Evelard's main duty was carrying out research on American companies with growth potential, namely hot and glamour stocks. Although he did not then know what a better way of investing might be, he felt that the growth method involved too many aggressive assumptions, leaving no room for error. Searching for an investment approach that would fit his style, Evelard came across the name Benjamin Graham. He recalled, "After moving to New York, I met some French students from Columbia University. One day while cycling with them in Central Park, I shared my frustration with growth analysis, and they told me to read the books published by former Columbia professor Benjamin Graham. I bought a copy of Security Analysis, and, after finishing it, I read The Intelligent Investor. Right away, I said, voila. This is the investment concept I've been looking for." Quickly becoming a value advocate, Evelard preached the gospel of the intelligent investor to his colleagues, but no one listened. Feeling alone in New York City, he requested a move back to Paris in 1974. Although the bank initially asked him to manage a small investment fund upon his return, senior management soon rescinded the offer. The next 4 years back in France were among Evelard's most miserable professionally. The only value advocate at Société Générale, he was forced to adopt the growth investing approach, although his heart remained true to the value investing philosophy. Finally, in 1979 he was given the chance to relocate back to New York City, and this time his new duties included managing a small global investment fund. He joked, "My boss knew I wasn't too happy at work, and by sending me over to New York, he wouldn't have to listen to my talk about value anymore." I was assigned to manage the SOGEN International Fund, which had only about $15 million in assets. Because the fund was so small, the head office in Paris didn't care much about it. In fact, I managed the fund all by myself until 1986 when management began to notice my performance. They acknowledged me because I started sending some nice dividends back to the head office. Looking back today, Evelard has no idea why value investing made so much sense to him right from the beginning. He commented, "I think Warren Buffett once said that value investing is a concept that you either understand right away, or you don't. Either you are a value investor, or you aren't." it is unlikely that a person would gradually be converted into one. Although the Frenchman may not know exactly why he is all about value, his upbringing perhaps provides a clue. Valley of Tears. The son of a railroad engineer, Jean-Marie Evelard was born in 1940 in Poitiers, west-central France, when half of the country was occupied as part of World War II. To escape bombardment in the city, the Evelard family moved to a small village to the south of Poitiers. We stayed with my grandparents during the war, and I have memories of troops coming in and out of the village and of some German officers occupying my great-aunt's house. The world was uncertain, but life moved forward. My mother gave birth to 4 of her 5 sons, including me, during the war, so life was eventful for our family. After the war, we moved to the French occupation zone in Germany because my father had to help fix the railroad network that was destroyed during the war. Evelard recalled a lesson learned during Mass after his family returned to France when he was 9 years old. During their sermons, the priests would always preach to us that we are sinners and that we are weak individuals who live constantly in sorrow while on earth. True happiness, therefore, would not come until we entered heaven. I recall the priests telling us that we all live in the Valley of Tears. Knowing that the world would be a permanent disappointment, I never expected to be happy every day. What puzzled me after coming to America is that many people see psychiatrists because they are unhappy, but if you expect life to be unhappy to begin with, then you don't really need help. You just press on and move forward. Evelard further applied this observation to the investment world. I think one of the reasons I didn't enjoy growth investing was because it assumes the world to be perfect and certain, which it is not. Becoming a value investor allowed me to acknowledge the fact that I am uncertain about the future, so my priority is to avoid losing money, rather than to generate big returns. Now, if value investing works, which I think it does, then how come there are so few value investors out there? I think it has to do with human psychology. By being a value investor, you are a long-term investor. When you are a long-term investor, you accept the fact that your investment performance will lag behind that of your peers or the benchmark in the short term. And to lag is to accept in advance that you will suffer psychologically and financially. I am not saying that value investors are masochists, but you do accept in advance that your reward, if any, will come in time and that there is no immediate gratification. In many ways, Evelard's childhood experiences groomed him into a value-oriented man. Reading Graham's The Intelligent Investor gave him the conviction and confidence to become a value investor, teaching him the importance of humility, caution, and patience. He explained, "You need humility because you know you can be wrong, and when you admit that you stress caution by assigning a margin of safety to your investments so that you don't overpay for them. Finally, you need patience to wait until they play out because, as Graham said, in the short run, the market is a voting machine, but in the long run it is a weighing machine." The inefficient market. When Evelard began to manage money in 1979, he noticed that many investment funds had no clear investment framework. Their objective was to beat the benchmark index, but their way of doing so was to time the market by trading in and out of index component stocks. Distinguishing himself with a value strategy, Evelard went against the crowd to look for undervalued stocks that others overlooked or ignored. The search for undervalued stocks begins with the idea that stocks are not just pieces of paper that are traded in the market. Every stock represents a business, which has its own intrinsic value. To determine that value, you have to estimate what a knowledgeable buyer would be willing to pay for the business in cash. It is important to understand that intrinsic value is not an exact figure, but a range that is based on your assumptions. Because you have to revise your assumptions from time to time to reflect business and market conditions. Intrinsic value fluctuates over time, and it can go up or down, he explained. Evelard admitted that he was rather lucky in his timing. When he took over the Sogen International Fund, stock markets were generally beaten down after the global sell-off in the 1970s. In the beginning, his main strategy was to apply the Benjamin Graham approach. I looked at stocks in both the US and Europe. Instead of focusing on how the economy in each was likely to fare, I focused mainly on stocks that were trading at 30 to 40% below my intrinsic value calculations. Because the Graham approach is mostly mathematical, I sat in the office all day trying to determine companies' liquidation value or net working capital from their balance sheets. The first opportunities came from the United States, where both small and large-cap stocks were beaten down. Then, as the U.S. market began to recover in 1982, value started to appear in continental Europe. Evelard recalled, European small caps were selling at ridiculously low levels by Graham's definition. I think one reason they were cheap was that continental Europe had a less transparent financial disclosure environment than the U.S., and therefore the market was less efficient. Speaking of efficiency, my experience also makes it difficult for me to believe in the efficient market hypothesis, which posits that it is impossible for investors to beat the market because stock prices are always fair and reflect the most up-to-date information available to them. Discussing some of the inefficiencies that exist in the European market, Evelard mentioned that during his college years, he worked at a magazine called La Vie Française, a publication somewhere between Barron's and Business Week. During his time there, he noticed that the journalists liked to speak favorably of big companies that advertised in the publication, and less favorably of smaller non-advertisers, a situation that created price discrepancies between large and small-cap stocks. He also observed that some companies were inclined to report earnings that closely matched their dividend payments because the labor union would go after management if the company generated too much profit. Misreported earnings thus led to inaccurate evaluations of many European businesses. Finally, Evelard found some companies simply hostile to potential investors, making their annual reports or related filings difficult to access. If public information was not very public, he questioned whether the market was truly efficient. He explained, applying the Graham model, I focused on hard and real assets. If they were selling at huge discounts to their stock prices, then I would buy. Eventually, as financial reporting became more transparent, these small-cap stocks went up in value. In the 1980s, some fund managers questioned me for buying these small-cap stocks because, if my fellow fund managers did not buy them, then they could hardly go up in value. Maybe they were right, but I believe that if a stock is cheap, then investors will eventually recognize its value. It may take 3 years, 5 years, or even longer, but the truth is that investing requires patience, and you need a huge amount of it to see good things happen. The Graham method of searching for undervalued stocks proved to be profitable, but as the world became more efficient, the strategy became less competitive. Fortunately, in the late 1970s, Evelard came across the name Warren Buffett and had the opportunity to read many of his Berkshire Hathaway annual reports. He then began to put the Buffett approach to use in the mid to late 1980s. Evelard said, value is a big tent. You have Graham, who does it mathematically, and you have Buffett, who made a substantial adjustment to Graham's teaching by looking not just at the numbers, but also at the long-term prospects and quality of the business. The Graham approach was less time-consuming, and so I could work on the numbers on my own. Toward the end of the 1980s, I began to hire analysts so we could apply the Buffett approach. Having more people allowed us to spend a lot of time trying to find out the major characteristics of businesses and their sustainable competitive advantage, what Buffett calls a business moat. Although he broadened his investment research, Evelard stressed that in this period he remained a bottom-up investor who focused primarily on the intrinsic value of a business. However, he then also began to keep an eye on the top-down. So he looked at the macroeconomic environment of different countries. We could ignore the economics of the more developed markets, but as we moved into analyzing emerging markets, we had to keep an eye on the bigger picture. Some emerging market stocks in Asia presented extraordinarily attractive valuations in the 1980s, but some of their respective countries were rife with political and economic instabilities, and so we had to be extra careful. In addition to understanding businesses, we also had to make sure their accounting systems were honest, as we had learned from experience that the numbers can't be trusted if management intends to mislead investors. Speaking of accounting, Evelard regrets that the accounting standard in developed countries became worse than those in emerging countries in the 1990s. He said, somehow, the integrity of accounting changed. When the economy was growing and every business was successful, the chief financial officers of virtually all large corporations in the U.S. began to think that they wouldn't go to jail for being intellectually dishonest because everyone was doing it, and so they started manipulating the numbers. I always start off my research by reading companies' annual reports and then the footnotes to their numbers. I need to be satisfied about the integrity of the numbers and the honesty of the accounting before I look further. If there is any number that is incomprehensible, I throw the report into the wastebasket and move on. If you look at Enron's footnotes in the 1990s, they were just incomprehensible. If investors had read those footnotes carefully, I don't think anyone would have invested in Enron stock. The trouble with American accounting, according to Evelard, is that it has extremely detailed rules. Good lawyers and CFOs will not get caught if they can find a way to work around those rules and manipulate the numbers. In Europe, however, accounting is more principle-based. Thus, one would violate the accounting system simply by betraying its fundamental spirit. Regardless of which accounting standard is in place, Evelard believes that the most important exercise for potential investors is to read through companies' annual reports, and never take any numbers for granted. Successful investing is not just about achieving stellar returns, it is also about avoiding losses. When the numbers appear questionable, the best practice is to forego the opportunity and look for the next one. The meaning of value. When a company's financials make sense to Evelard, his next step is to value the worth of the business. We don't do much discounted cash flow analysis because it gives you an impression of worth down to the decimal point, which does not require being so precise. Instead, we prefer using EV/EBIT, enterprise value/earnings before interest and taxes, because it introduces the balance sheet to the multiples. The main goal of the analysis is to find out approximately how much the business is worth, in a reasonable range, if a knowledgeable buyer were to take over the company. By using EV, we include both cash and debt in the calculation, which is better than just looking at market capitalization. Then, with EBIT, we see how much interest the company is paying. Since we prefer companies with little to no debt, we expect minimal interest expenses. Then tax is also a concern because if a company pays a lower tax rate than its peers, we have to find out why. If there is no valid reason for a lower tax rate, then either the company is cheating the tax authorities or it is overstating its profits. After a business is valued, the next step is qualitative analysis. This exercise focuses on the strengths and weaknesses of the business, not from the standpoint of whether the company can increase sales or earnings over the next quarter or two, but from whether it has any sustainable competitive advantage over the next 5 to 10 years. Evelard commented, "After I retired in 2006, I helped teach a value investing course at Columbia University. I had about 12 students, and what struck me was that 11 out of 12 thought qualitative analysis had to involve 25 pages of writing. What I tried to stress to them was that they needed to think hard and then list no more than 3 to 4 strengths and weaknesses of the business. Besides, some of the best analysts I have dealt with have enjoyed explaining complicated situations and how a company could turn itself around, and so forth. I always tell them that they are smart, but the more complication they try to read into the story, the higher the probability that they will make a mistake. I tell them that there is nothing wrong with making money through simple investment ideas. After all, that's what Warren Buffett has done for years. As he has said, he doesn't jump over 7-foot bars, he looks for 1-foot bars that he can easily step over." During his investment career, Evelard made it a point never to speak to company management until after he had done his homework. If the first question he asked gave management the impression that he knew nothing about the company, then they would have a greater tendency toward painting a good picture of the company. Instead of asking questions about the company's latest earnings outlook or long-term strategic plan, Evelard's goal was always to get a sense of the management team's personality. He explained, "There is no point asking about a company's earnings outlook because if we are investing for the long term, then short-term earnings never affect our intrinsic value calculation. Asking management about long-term plans is also pointless to me because the world changes. No one can predict what will happen, and so what is more important for us as analysts is to discover the underlying strengths and weaknesses of the business ourselves." Because the world is uncertain, Evelard has never believed in a concentrated investment portfolio. "I think a concentrated portfolio is more of a bull market phenomenon. In a bear market, if you are too concentrated, you never know what can happen to your stocks. Some people have asked me whether I just invest in my best ideas, but the truth is that I don't know in advance what my best ideas will be, so I'd rather diversify. Besides, the beauty of our global fund was that we could invest internationally, which helped to minimize country-specific risks. With that in mind, I am not saying that you should diversify the portfolio to the extent of creating a quasi-market index." As his investment horizon has always been at least 5 years, Evelard has never minded buying a stock on its way down. In fact, he believes that if a value investor has performed his or her calculations carefully, then a falling stock represents a good opportunity to load up with more. The only worry, then, is the fluctuation of intrinsic value over time because business conditions change. He explained, "We don't set a specific target price for our stocks, but we monitor their intrinsic value closely because businesses can be better or worse than expected. We also read a lot of analysts' reports to get updates on businesses, but we always calculate their intrinsic value on our own. The trouble with analysts' reports is that their time frame is usually 6 to 12 months, but ours is 5 years. So, it is fine to read what they say about businesses, but not their target prices." Evelard does not believe in the existence of a value trap. He does, however, believe in what Martin Whitman of the Third Avenue Value Fund said about the difference between a temporary unrealized capital loss and permanent capital impairment. If a stock is worth $70 and is currently trading at $35, it is a value stock. If after a year the stock drops to $25 but, based on prudent assessment, the value investor believes that it is still worth $70, he or she should not panic because the stock is simply going through a temporary unrealized capital loss. As long as the investor is patient, the stock will eventually reflect its true worth. Permanent capital impairment, in contrast, is a pure mistake. It occurs when the value investor misjudges the strengths and weaknesses of a business and comes up with a deteriorating intrinsic value. Then the loss is not temporary, but permanent. Hence, the value investor should quickly cut the loss, learn from the mistake, and move on. Evelard further elaborated, "I think traders and speculators call it a value trap because their holding period is too short. If the intrinsic value of a stock remains unchanged, then even if its price goes down, it is still a value stock. You can't say that it is a trap just because your holding period is mismatched with the time it takes for the stock to recover. If you have patience, and if your analysis is right, then the market will acknowledge the stock eventually." The courage to say no. Although patience is required for value stocks to blossom, the value investor also needs the courage to say no, especially in times of market frenzy. Sometimes in life, it's not just about what we buy, but what we don't buy, Evelard explained. Because I became worried about the Japanese stock market in the late 1980s due to its gigantic credit boom, we sold all of our Japanese stocks in mid-1988. Some investors questioned us for pulling out from the second largest stock market in the world, but I said it's better to take some money off the table than to participate in market mania. Obviously, I was wrong and unhappy in the next 18 months because the market went up another 30%, but in 1990 when the market collapsed, we owned nothing in Japan and our decision was proved logical. In the late 1990s, a similar situation occurred in the United States. This time it was technology, media, and telecoms mania. Evelard's performance lagged behind that of his peers and the major market indices for 3 years, but he continued to say no to the market. He explained, "If you lag in the first year, your clients are okay with it. If you lag again in the second year, they get nervous. And if you lag in the third year, they are gone." Our fund had total assets of around $6 billion in 1997, but by 2000 it was down to $2 billion. I was unhappy, but I constantly reminded myself that I was acting in the best long-term interests of our investors, so I had to do the right thing. When the mania was over, investors came back and praised our discipline. The fund, the First Eagle Global Fund, today has a size of close to $30 billion. In the 2000s, Evelard stayed away from financial stocks because the easy credit and low interest rates that prevailed reminded him of Japan. In the late 1980s, he noted that both the US and European banking industries had been highly regulated in the 1960s and 1970s. In those years, bank stocks traded at slightly below their book value and yielded around 4 to 5%. In effect, they were as boring as utility stocks. In the 1990s, however, the regulations changed, and banks began selling investment products and structuring exotic deals. As they began to generate hefty profits, Evelard became wary of the industry's structure. First, the financial sector became bloated. Then, with the easy monetary policy and overall prosperity in the 1990s, which became even more amplified in the 2000s, the market became extremely risky, Evelard said. My worry was supported by the Austrian School of Economics, which suggests that monetary authorities should be careful not to let a credit boom go on too long and become too strong, because a credit bust naturally follows a boom, just as night follows day. The problem is that no one was listening to the Austrian school because post-World War II economics had been dominated by two economists, John Maynard Keynes and Milton Friedman. Since the two were friends with many politicians, and could offer solutions to many economic issues, they became more accepted. The Austrian school, on the other hand, provided hopeless messages by saying that the world cannot do much as credit boom turns to credit bust. Time is the only healer of any economic problem. It also suggests that any attempt to patch things up in the short term runs the risk of negative unintended consequences in the medium to long term. With quantitative easing by central banks and increased government spending to stimulate the world's economy after 2008, low interest rates have continued. If the Austrians were right, everything will be fine in the short term, but the unintended consequence will be higher inflation in the medium to long term. We have to remember that inflation is not asset prices going up or an increase in the consumer price index or commodity prices. It is just a symptom. Inflation is the excessive supply of money and the creation of credit. With the dynamics of the financial world changing since 2008, Evelard has two pieces of advice. Look for a career outside the financial markets and seek refuge in gold. He shared the story of renowned Austrian economist Ludwig von Mises, who declined an offer to work at a bank in the 1920s and continued to teach at Vienna University instead. His fiancée asked him why he had turned down such a highly paid job, and his answer was that the excessive credit boom of the 1920s would naturally be followed by a bust. Therefore, the last industry in which a person should wish to work would be banking. Fast forward to the 2000s, when Evelard's daughters asked their father why he had never pushed them into the finance industry. He told them the same story. With regard to gold, Evelard believes it to be an essential asset class in good and bad times alike. Seeking protection. As a value investor, Evelard has never claimed to know the intrinsic value of gold, although his extensive reading about the failure of fiat money throughout European history makes it natural for him to speak positively about the yellow metal. After all, in an age of uncertainty, gold always provides protection and insurance against extreme outcomes. In 1993, Evelard set up the first Eagle Gold Fund on the assumption that there would continue to be an imbalance between the annual supply of and demand for gold. He explained, "I set up the gold fund 6 or 7 years too soon because I thought the downside was protected due to the imbalance of supply and demand, and I thought that the upside would take care of itself at some point. What I didn't understand was that supply and demand don't matter. What matters is whether there is investment demand." Obviously, the lack of demand at the time did not drive up prices. The fund started out with $50 million and was down to $15 million by the end of the 1990s. Now, 2011, it is worth a little over $3 billion thanks to investment demand. Evelard argued that gold has no intrinsic value, just as paper currencies such as the US dollar, euro, or Japanese yen have no intrinsic value. Gold is a substitute currency. Because there is too much paper money and too little gold out there, every major currency became suspect after the 2008 financial crisis, and the alternative was to have some allocation of gold. As gold prices can easily fluctuate by a couple of $100s, investors need to be careful even if their aim is to seek protection. To illustrate the failure of fiat money, Evelard cited a few historical incidents. For example, in 1716, when France found itself in financial ruins following the numerous wars launched by King Louis XIV, John Law, the country's Controller General of Finances, decided to issue paper money backed by coinage to repay the country's unsustainable debt. He continued to print money, made it illegal for French citizens to hold more than a certain amount of gold and silver, and devalued the country's banknotes relative to foreign currencies to improve exports. The schemes eventually led to public retaliation, and, in 1720, the paper money system collapsed and the once celebrated John Law had to flee the country. Evelard also mentions 1790 when, after the French Revolution, the French Assembly confiscated church lands and used them to back a new type of paper currency called the assignat. Initially issued with 400 million livres, by 1795, its total circulation had reached 40 billion livres, causing rampant inflation and public outcry. When Napoleon entered the scene, he introduced the gold franc, which was backed by gold alone. Only then did France's financial situation stabilize, and his reign was secured. In more recent times, the Treaty of Versailles imposed punishing financial reparations on Weimar Germany after the end of World War I. To pay down its war debt, the country had to print money, but the more it printed, the faster the value of the mark dropped. Germans initially reacted to the resulting higher prices by economizing on their consumption, but when the value of the mark dropped faster than they could consume, they spent their paper money as fast as they could, causing hyperinflation in the 1920s. Many historians argue that the situation led indirectly to the rise of Hitler, the aftermath of which was World War II. Evelard said, "We Europeans learned long ago that paper money doesn't work." In the US, the pure paper money system is only around 40 years old since Nixon closed the gold window in 1971. With the excessive amount of money printed since the financial crisis in 2008, paper money is fraying at the edges. Now we have too much paper money chasing too little stuff, with the stuff being gold. His personal savings are invested in both the First Eagle Global Fund and the Gold Fund, as Evelard knows that value stocks and gold will make good companions in the years to come. Reaching the age of 65 in 2004, he decided to retire because, as the French say, il y a un temps pour tout, there is a time for everything. In their travels in Europe and the United States following Evelard's retirement, he and his wife, Elizabeth, came to appreciate fine art and gradually began to collect drawings. In the midst of their search for their next piece of art, Evelard received an unexpected phone call in 2007. His successor at First Eagle Funds had stepped down, and the Frenchman was asked to come out of retirement to oversee the transition to a replacement. "At first, I thought I would just be around for a few months, but it took much longer to find a replacement, so I ended up staying for 2 years," he recalled. Officially free of major responsibilities since 2009, Evelard continues to serve as a senior advisor to First Eagle Funds. Although traveling and art collecting are now his major retirement hobbies, he continues to keep track of the financial markets and occasionally discusses the failings of the global economy in business magazines and on television. Speaking of the future, Evelard concluded, "The key question today is this: are we still in the post-World War II economic and financial landscape, or have things changed as a result of the financial crisis in 2008? I don't pretend to have the answer to this question, but as the future is uncertain, my advice is to remember the importance of a margin of safety. As a value investor, you can be bottom-up all you want, but remember to pay some attention to the top-down because government policies are having a severe impact on the health of the world's financial markets." Chapter 6. The Self-Taught Value Spaniard. Francisco Garcia Perez. Bastion ver Asset Management. When you have eliminated the impossible, whatever remains, however improbable, must be the truth. Sir Arthur Conan Doyle. Francisco Garcia Perez is the Chief Investment Officer of Bestinver Asset Management, a wholly owned subsidiary of Spanish industrial conglomerate Acciona, S.A. Incorporated in Madrid in 1987, Bestinver originally managed the wealth of the Entrecanals family. Joining the firm in 1989, Perez gradually took Bestinver to the next level by setting up its first equity fund, Bastion Fund, in 1992. Then, in 1997, Bestinver launched a global equity fund called Bestinver Internacional, managing Bestinver's funds single-handedly until 2003. Perez has generated stellar investment results not only within the Spanish community but within Europe as a whole. From Bastion Fund's official launch on January 13, 1993, the fund returned 1,447%, or 15.76% annually, until 2001. Its benchmark index, the Madrid Stock Exchange General Index, returned 329%, or 8.1% annually, during the same period. Bestinver's other notable fund, Bestinver Internacional, which was launched on December 31, 1997, had generated 221%, or 8.85% per annum, as of 2001. Its benchmark index, the MSCI World Index, dropped 2%, or minus 0.15% annually, during the same period. Managing approximately €5.4 billion, or $7.4 billion, as of 2001. Perez now works closely with two other fund managers, Alvaro Guzmán de Lázaro Mateos and Fernando Bernad Mares. Investing is about common sense. Charlie Munger, vice chairman of Berkshire Hathaway, once said, "All I want to know is where I'm going to die, so I'll never go there." The same concept applies to investing. Spanish investor Francisco Garcia Perez believes that an investor doesn't need to make personal investment mistakes to find out what doesn't work. What's needed is to read about others' mistakes and never follow them. A self-taught value investor, Perez joined the investment management industry by chance. Born in the north of Spain in the Galician city of A Coruña in 1963, Perez is the second youngest of 5 children and the only son in the family. When he was young, he had little idea of what he wanted to do in life. If he had to pick a career during his teenage years, however, he would have chosen to play basketball professionally, and he remains a big fan of the NBA in the United States. With an open mind about his future, Perez attended Complutense University in Madrid, where he studied economics because the subject seemed much broader than others, such as law or accounting. He recalled, "I didn't know anything about business until my 3rd year in college, when I started reading Businessweek magazine to catch up on business news and improve my English. Having learned what companies do, in my last year of college I began working at Spanish department store El Corte Inglés doing paperwork for the purchasing department, which technically involved filing import and export documents for merchandise. Because I really didn't know what to do after graduating in 1987, I decided to study for an MBA at the IESE Business School in Barcelona. Around the time I finished my MBA in 1989, the school had a job recruitment day. Bestinver was there, and I was hired on the spot as an investment analyst." Perez admitted that he knew little about the role when he joined Bestinver. However, having evaluated his strengths and weaknesses and feeling fairly certain of what he should not do, if not what he should, he liked the sound of a career that required him to be analytical more than one in some other business area, such as sales and marketing. As a self-described, quiet person, an opportunity to be analytical seemed well suited to his personality. In 1989, Bestinver was still a relatively small division within the Intricacies business empire. Perms recalled, basically, it was just me and my boss. We were supposed to analyze merger and acquisition opportunities in Spain, but such activities slowed down shortly after I joined. To keep myself occupied, I began to analyze Spanish stocks. Because my boss had a very value-driven mindset, his fundamental approach provided me with a good investment framework, and fortunately I was pointed in a sensible investment direction. Early in his career, Perms noticed that investing constitutes value seeking in the first instance. Moreover, he observed that financial institutions distinguish between the concepts of growth and value, probably for marketing purposes. As a European who had read extensively about the rise and fall of many family empires within the region, he realized that those that weather crisis after crisis are the ones that look for investments with sustainable growth and value over the long term. If these empires had been speculative and myopic to begin with, then how could their legacies have lasted for centuries? Indeed, Perms's fundamental investment beliefs were confirmed by Warren Buffett when he wrote in his 1992 annual letter, "In our opinion, the two approaches, value and growth, are joined at the hip. Growth is always a component in the calculation of value, constituting a variable whose importance can range from negligible to enormous and whose impact can be negative as well as positive. In addition, we think the very term, value investing, is redundant. What is investing if it is not the act of seeking value at least sufficient to justify the amount paid?" When his boss left Bestinver in 1991, young Perms was on his own in the research department. He said, "I learned about value from my boss, but more importantly, my investment framework was further consolidated after reading the book One Up on Wall Street by Peter Lynch." I still remember when the book came out in 1989, and I read a review in Business Week. I went out and bought it, and it changed my life forever. Among the words of wisdom that struck Perms in reading One Up on Wall Street are these: "Stock prices often move in opposite directions from fundamentals, but long-term, the direction and sustainability of profits will prevail. It takes remarkable patience to hold on to a stock in a company that excites you, but which everybody else seems to ignore. You begin to think everybody is right and you are wrong. But where the fundamentals are promising, patience is often rewarded. It's only by sticking to a strategy through good years and bad that you'll maximize your long-term gains." Perms added, "I think I had the value gene in me to start with, but Lynch's book really reinforced and developed my investment logic. After Lynch, I read all of the books that I could find on value investing. Just a few of the investors I read about were Warren Buffett, Benjamin Graham, John Neff, Sir John Templeton, Walter Schloss, and Philip Fisher. With little pressure on me from the Intricacies family in my first 2 years of employment, I was fortunate to be able to learn at my own pace." On a solo value hunt. After his boss's departure from the firm, Perms asked the Intricacies family whether he could continue to run Bestinver's portfolio on his own. To his delight, they approved his request. He explained, "In my first 2 years of doing investment analysis, I was convinced that a prudent manager could definitely add value to a portfolio to improve investment returns. I have always been shy, but somehow I was quite confident about what I was doing, so I had the courage to ask. I am grateful to this day that they let me run Bestinver's funds on my own." Bestinver had a capital injection of about €10 million to begin with. This was a lot to me, but not a huge amount for the Intricacies family. Because the family put little pressure on me, I could really focus on value, think for the long term, and put my investment principles to work. I knew that if I could build up a nice track record, I would eventually be given the chance to build something bigger. Because he was able to do something on his own at such a young age, Perms now advises young people to start investing as early as possible. What is important, he believes, is to have the right investment mindset and to build a track record no matter how large or small the size of the portfolio. If the investment logic is sensible and the record is acceptable, then you will be recognized over time. Perms vividly remembers his very first investment research, which was on the Acerinox Group, a steel company in Spain. His work showed him the cyclicality of businesses and the way in which they go through peaks and troughs along with the economic cycle. Being a prudent investor requires patience and discipline because it is easy to get carried away in a bull cycle or overly discouraged in a bear cycle. Perms early on took Sir John Templeton's words to heart. The four most dangerous words in investing are, "This time it's different." Discussing the first investment he ever made, Perms recalled, "I was about 27 years old at the time, and I bought into the Spanish bank Banco Santander. This was before the Persian Gulf War in 1990, and stocks were quite beaten down. My position dropped 30% over the next 2 years, and I bought more. 6 years later, I sold it and made a nice gain. This was the only time I used leverage to buy a stock, and I remember borrowing around 20,000 euros from my father and friends." Perms further added that Banco Santander was one of the very few personal stock investments he has ever made because when Bestinver officially launched its own fund in 1993, he began to put all of his personal savings into the fund to align his interests with those of his investors. Although he made money with Banco Santander, Perms learned 2 important lessons. The first was that bank stocks are too difficult to understand. In the early 1990s, Spanish banks had loan-to-deposit ratios of 50 to 70%, which was both conservative and healthy. But by the mid to late 2000s, those ratios were nearly 150%. With so much leverage in the system and with bank assets so difficult to evaluate, Perms decided not to touch the sector again unless the situation changed. Banks continued to overleverage themselves, and he continued to stay away. When the financial crisis hit in 2008, Bestinver was not as badly affected as many other investment funds that had exposure to the financial industry. "The second lesson I learned," Perms said, "is not to use leverage because anything can go wrong. It's normal for a 25-year-old or a 30-year-old to leverage up on an investment because a young person always wants to get rich quickly. But after reaching a certain age, one begins to realize that it is harder to make up for losses than to protect against them, and so the whole investment game is about quality and sustainability. What matters most in the process," he continued, "is to find value stocks with good positions in the marketplace because they will be around for a long time." Peter Lynch's motto is very true: go for a business that any idiot can run, because sooner or later, any idiot probably is going to run it. The idea is not just to find cheap businesses, but to find good businesses. I learned that a cheap business can kill you, but a good business won't. I remember investing in a Spanish textile company that was selling below net cash. The stock was cheap, but the business was so lousy that the management team not only failed to keep it operating, but also lost all of its cash and assets. So sustainability and quality matter. Investing made simple. Proving his investment know-how for another 2 years, in 1993, Perms began managing Bestinver's first investment fund, Bastion Fund, which focused primarily on Spanish stocks. In 2005, however, its investment mandate was changed to include international stocks. The rationale for the change was that local stocks provided little value at the time, hence to improve its flexibility, the fund began to look to surrounding markets. Perms explained his investment process. First and foremost, I read a lot, and we never use investment screens to generate any ideas whatsoever. Our ideas come from reading newspapers, books, magazines, analysts' reports, and even our competitors' investment holdings. We also frequently brainstorm with people from different industries. It is important to know that idea generation comes from having a consistent understanding of the world, and synchronizing it with all of the information you have accumulated. It is a disciplined process, and the sooner you begin this exercise, the more prepared you will be when opportunities arise. Ideas are not generated simply by waking up one day and saying, "Let's look for an idea." They require the accumulation of investment experience and the desire to learn over time. Deeply focused on investment research and analysis, Perms rarely allows market noise to affect his well-being during the day. In fact, he does not check stock quotes until 6 p.m. each day. After all, he understands well enough from his reading of Benjamin Graham that the stock market is merely a platform for serving investors, not affecting their emotions. Perms stressed that when analyzing an investment, he does not use complicated financial models to evaluate it. "All I use is a simple calculator to add, subtract, multiply, and divide." For example, we rarely use the discounted cash flow model to calculate the value of a business unless it is a very stable one, such as a toll road or a utility company. I think it is not how sophisticated you are in your valuation model, but how well you know the business and how well you assess its competitive advantage. This cannot be modeled mathematically, but has more to do with the investor's own experience. To determine competitive advantage, Perms determines whether a business will still be around in 10 years' time and whether its business model undergoes frequent change. If it fulfills these two prerequisites, then his evaluation process revolves around what makes the business special. For example, does it enjoy strong pricing power? Or does its industry have a high entry barrier to new threats? Although it is always ideal to speak to a business's management team, talking to its competitors, customers, former employees, and business suppliers is just as crucial. Perms explained, Warren Buffett said that, "Risk comes from not knowing what you're doing." Reducing risk is not about adding assumptions and complicating your investment model, but about simplifying by investing in what you know best. If you believe that a business is sustainable, then you should think like an entrepreneur and try to calculate how much the business is worth, as if you were taking it over. If it is selling at a discount, then you have found value. Believing that the fundamental concept of investing is to look for simple ideas, he concurs with Buffett, who once said, "I don't look to jump over 7-foot bars. I look around for 1-foot bars that I can step over." Perms employs simple valuation multiples to evaluate his investments. He particularly likes to use the price-to-free cash flow ratio, which is a company's market capitalization divided by its free cash flow, FCF, that is, the cash flow available for distribution to stakeholders. Found in the company's cash flow statement, FCF is operating cash flow minus capital expenditures. He explained, "We like to buy good quality businesses with FCF multiples of less than 11 to 12 times. Our target price is usually set at 15 times. The rationale for 15 is that it is the long-term average at which stocks generally trade. It also implies a FCF yield of around 6.6%, not too bad in most market environments. Of course, we always play around with the sensitivity of our assumptions to come up with a comfortable multiple. For example, if a business is good, then we use 17 times, if it is cyclical, then maybe 13 times. Although this type of analysis sounds too simple to be true, it requires a prudent investor to come up with a reasonable estimate of the long-term FCF figure before assigning a fair multiple to it. Thus, applying such a method takes considerable skill and judgment. The FCF method focuses on the valuation of a business. To determine its quality, PRMS employs return on capital employed, ROCE, 3, which measures the efficiency and profitability of its investments. In short, how well is the company deploying its capital? PRMS believes that ROCE enables him to evaluate the quality of a business objectively. This metric gives him a good idea of the business's historical trends, and it also allows him to compare capital returns among different businesses. He elaborated, ROCE helps us to understand the competitive landscape of industries, from which we can try to determine the competitive advantages of different businesses. There is no ideal figure for ROCE. It is a moving number from quarter to quarter and from year to year, but we generally look for companies with consistent returns, and so we think around 20% is pretty good. The most important thing is to understand the business prospects. Even if ROCE looks good based on historical trends or in comparison with the business's competitors, it can still be a trap if the business does not have pricing power going forward. For example, if its profit margin is being squeezed by competition or inflation. Austrian Economics and the Market. Legendary investor Philip Fisher wrote in Common Stocks and Uncommon Profits, "The amount of mental effort the financial community puts into this constant attempt to guess the economic future from a random, and probably incomplete series of facts makes one wonder what might have been accomplished if only a fraction of such mental effort had been applied to something with a better chance of proving useful." Echoing Fisher, Buffett once said, "Forecasts may tell you a great deal about the forecaster, they tell you nothing about the future." Following Fisher's and Buffett's principles, PRMS has never been too concerned with the market consensus. This does not imply that he disregards macroeconomic figures. He follows such figures as gross domestic product growth, unemployment rates, and inflation rates to track the growth and stability of different markets. After all, the growth of a business is always affected by the growth of the economy in which it operates. He explained, "I don't focus on the consensus opinion about a company or the economy because everyone has his or her own reality. My objective in life is to find my own truth and reality, both professionally and personally. There are too many forecasters, and they can be right for the wrong reasons or wrong for the right reasons. To remain focused, I have adopted Austrian Economics as my investment framework." PRMS was introduced to Austrian economics in 1997 when he began studying the philosophy of Ludwig von Mises and Friedrich Hayek. Unlike mainstream macroeconomic models, such as the Keynesian model or the Chicago School model, which involve a more mathematical way of analyzing the economy, the Austrian model has more to do with the observation of human action, also known as praxeology, the objective of which is to understand how different individuals affect economic phenomena. Mainstream economics focuses on empirical data, which leads economists into analyzing data and forecasting them. Because this exercise appears to be more scientific, politicians can use it to propose solutions to improve the economy, PRMS explained. The Austrian school believes that human actions cannot be predicted and that everyone has his or her own agenda under different circumstances, and so there is no real solution to curing real economic situations. In the long term, however, human actions will be adjusted accordingly and bring the economy to a normalized state because people are by nature entrepreneurial, whereas mainstream economists believe in market equilibrium and perfect competition, with each individual theoretically the same and striving for the same goal. The Austrians believe the market to be full of flesh and blood decision-makers, who compete in the economy spontaneously through trial and error. This means the market is always at disequilibrium because different individuals have different intents, and are constantly changing their actions, whether due to human error, the discovery of new information, a revised strategy, or personal constraints. To give a simple analogy, the mainstream believes that the market is perfect to the extent that finding a dollar bill in the street would be too good to be true. If it was really there, then it would have been picked up long ago. The Austrians, however, believe the market can be imperfect. Therefore, it is possible that there is indeed a dollar bill in the street, and one can profit from someone else's negligence because good deals do appear from time to time. The Austrian intellectual framework applies similarly to investing, as Perms further explained. It helps me to visualize how businesses evolve and compete, and how to distinguish between price and value in times of economic boom and bust. Because human behavior changes constantly, good businesses that became overvalued and bad businesses that became undervalued will eventually revert to their mean, because every businessperson, in the spirit of an entrepreneur, will play his or her part in creating and destroying value. As equilibrium is hard to reach, businesses either overshoot or undershoot. For the investor, this framework suggests that value investing works, because with the right analysis, one can find good stocks that trade at discounts, and with patience, these stocks will eventually revert to their true worth. Perms stressed that this discussion only scratches the surface of Austrian economics. For a better understanding of this school of thought, he recommends reading The Austrian School, Market Order and Entrepreneurial Creativity by Spanish professor Jesus Huerta de Soto. Reviewing his investment career, Perms mentioned that Austrian economics also gave him a sense of reassurance in the midst of market frenzies. I was getting worried in 1998 because stocks were becoming pricey. The Spanish stock market was up 39% in 1996, then 42% in 1997, and another 38% in 1998. With interest rates coming down from over 10 to 4% between 1995 and 1998, stocks had reasons to rally, but their valuations became quite unreasonable at one point. In the summer of 1998, Perms began to hold cash and utility stocks to defend his investment positions. His reading of Austrian economics suggested that a sustained period of low interest rates and credit creation would stimulate borrowing and growth in the economy, but when credit expansion became too excessive, human actions would naturally tend toward the extreme, thus creating a bubble and then a bust. I was convinced that a bubble was forming, and I was unwilling to compromise, Perms said. Clients were calling to complain that I wasn't taking advantage of the bull market, and those phone calls reached the point that I would have been more than happy to return their money and close down the business. I would rather have walked away than do something I wasn't comfortable with. The stock market fiesta continued. With internet stocks joining the party, every investor became a market genius. The Spanish market was up by 16% in 1999, but Perms's bastion fund was down by 11%. This was a difficult moment for Perms, but, in his darkest hour, he read an encouraging letter by Warren Buffett, who shared his view. In his 2000 annual report, Buffett wrote, Nothing sedates rationality like large doses of effortless money. After a heady experience of that kind, the internet bubble, normally sensible people drift into behavior akin to that of Cinderella at the ball. They know that overstaying the festivities will eventually bring on pumpkins and mice. But they nevertheless hate to miss a single minute of what is one hell of a party. Therefore, the giddy participants all plan to leave just seconds before midnight. There's a problem, though. They are dancing in a room in which the clocks have no hands. Indeed, stocks that defied logic did eventually turn into pumpkins and mice. In 2000, when the Spanish market tumbled 13%, Bastion fund was up 13%. In 2001, when the market was down another 6%, the fund was up 20%. In 2006, Perms sent a letter to Buffett to thank him for his encouraging words, noting that being the only Spaniard who kept his head when others were losing theirs was no easy task in the grip of market mania. Buffett replied with a handwritten note asking Perms for investment ideas in Spain. Although thrilled to be in touch with Buffett, Perms remained true to himself. He believed that Spain was about to go through tough times due to the country's credit expansion in previous years. The end result would be a collapse in the local real estate market, severely affecting the Spanish economy as a whole. It was better to stay out of Spain for the time being. With skepticism and foresight, Perms had sought investors' consent to change Bastion Fund's investment mandate to include foreign stocks in the portfolio as early as 2005. Diversification away from Iberian stocks was the only rational way to brace for the coming crisis. Although not directly related to his investment career, a plane crash in March 2006 had a profound effect on Perms. Flying to Pamplona in the north of Spain to attend an investor meeting, the plane in which he was traveling hit the side of a mountain and crashed, killing Bastinver's administration director and the co-pilot and severely injuring all of the passengers on board. Being the only person able to walk, Perms wandered the mountain for an hour searching for help. The accident taught him that in life and in investing, mankind's ultimate essence is the quest for survival. A global rebalancing. For many investment funds around the world, long-term is a luxury. Faced with constant pressure, fund managers are required to prove themselves in the shortest period of time to raise capital and retain investors. Bastinver, in contrast, has a unique long-term culture that is fully supported by its parent company, Acciona, and its owners, who provide not only part of its capital, but also a pressure-free environment for Perms to do what he does best. He explained, "I think Bastinver's competitive advantage is that it has a very long-term investment approach. By that, I don't mean the next 4 to 5 years, but the next 20 to 30 years. Many long-term funds have a stock holding period of 4 to 5 years, whereas we sometimes have a 10-year buying period for a stock. That's what we mean by long-term." A one-man band, Perms managed the Bastion Fund and Bastinver Internacional funds by himself until 2003, when Álvaro Guzmán de Lázaro Mateos joined Bastinver as fund manager. In 2006, another fund manager, Fernando Bernad Mares, also joined the team in its value hunt. With only Bastion Fund, I basically had to cover around 100 Spanish stocks. All I did was to keep close track of them and then reshuffle or rebalance them based on their stock performance, Perms said. After launching Bastinver Internacional in 1997, there were roughly hundreds of foreign stocks to cover. There is a saying that for every X kilometers, you have to divide the quality of your assessment by half. With a growing list of stocks to cover, Alvaro and Fernando apply their expertise to dig deeper in our analysis to make better judgments on foreign stocks. We also hired a Taiwanese analyst recently who is now stationed in China. He brings local knowledge to our understanding of Asia. Bestinver currently offers more than 10 investment funds. With several mutual funds, pension funds, and a hedge fund, this may seem an overwhelming workload for any investment manager, but Perms clarified, technically, we only have 2 portfolios, a global portfolio and an Iberian portfolio. All of our funds are really combinations of these two. What we do is blend the allocation of stocks from our 2 portfolios to fit the purpose of each fund. It is as if we are cocktail mixers with 2 ingredients, and yet we blend different drinks to suit clients' needs. A typical value fund has a low portfolio turnover rate, which means the manager does not buy and sell stocks frequently. Bestinver's funds, in contrast, tend to have very high portfolio turnover rates, often more than 100%. Changes in individual stock names, however, are typically few, with a replacement rate of only 25%. Perms elaborated, we quite frequently buy and sell our portfolio stocks, but the names of our stocks don't change. We may move a stock from a 2% weighting to 5%, and then move another holding from 7 to 4%. The thing is, when a stock has gone up 20%, it is 20% less attractive, and so we mix and match our stock weighting to create a comfortable balance for the portfolio. Unlike the US, which has a high capital gains tax, in Europe the capital gains tax is only 1% if you sell a stock within a fund. That gives us the advantage of being able to switch between stocks and rebalance them whenever we want. The real taxation comes at the fund level, and so I constantly tell our investors not to sell our funds, and to let us do the buying and selling of stocks. Fortunately, many of our investors are long-term driven, even passing the funds on to their children, and so they don't have to pay any taxes. Under European undertakings for collective investment in transferable securities, UCITS, rules, investment funds are not allowed to hold a concentrated portfolio of just a few stocks. Accordingly, Bestinver usually holds 50 stocks on average in its Iberian and international portfolios, with the top 10 holdings accounting for 40 to 50% of the portfolio. Reviewing his career, Perms said he believes that when an investment principle is sound, it is crucial to stick to it for the long haul and not compromise by following the world's fads and crazes. Many people chase hot trends or find a short-term catalyst in an investment. What we care about most is simply whether or not a business is going in the right direction over the next 10 years. If it is, then we patiently wait for it to realize its true value. We have some stocks that we have been holding for 15 years. After having been in the investment management business for 20 years, Perms admits that he has been doing exactly the same thing all this time. Obviously, his long experience adds value to his judgments today, but his investment process has always remained the same. He elaborated, I don't think the investment landscape has changed much because human mentality is always the same. Every economic situation is different, but there are always similarities. The Austrian Economics model explains this well. Whether the times are good or bad, I would say that the emotional quotient is more important than the intelligence quotient. Bestinver's success has made Perms a value investing force in Spain. He has shown the Spanish investment community that a prudent investment manager can really add value to an investment portfolio. Although the fund management industry in Europe is dominated by the big banks, the business of which is oriented toward a sales and marketing agenda, SPARX has proved that an independent fund house can be honest and direct in its dealings. SPARX and his team hold an investors' meeting every year, which he calls a wedding party, because it provides an opportunity for fellow investors to mingle and share ideas with one another. Similar to the annual Berkshire Hathaway meeting hosted by Warren Buffett and Charlie Munger, the Bastinver annual meeting gives investors a chance to ask SPARX any questions they like. The gala event instills investors with confidence and preaches the importance of a long-term mindset and discipline. Married in 1997, SPARX has 2 sons and 3 daughters. In addition to such family activities as vacations and visits to the beach, his main hobbies are watching basketball games and reading. As a father, he knows that setting a good example is the best way to teach his children. Value investing is similar. Indeed, although the value approach may never be trendy, at least a person will never go wrong by following its logic and principles. SPARX concluded, "The greatest joy in investing is finding an investment that is undervalued. The happiness that affords really can't be explained. When I find such an investment, I often think it must be impossible. Then I look again and, if it's really true, I am as excited as if I have found a treasure." That joy and passion is what I want to convey to my children because the world is full of treasures. If you don't find them, then you can still enjoy the journey, but if you do, then you have discovered the value of life. Chapter 7. The Income-Conscious Englishman. Anthony Nutt. Jupiter Asset Management. A wise man will live as much within his wit as within his income. Lord Chesterfield. Jupiter Asset Management is a UK-based asset management group that specializes in equity and bond investments for private and institutional investors. Established in 1985 as a specialist boutique, the company has since grown to become one of the largest and most successful British investment companies, with £22.8 billion in assets under management. As head of Jupiter's Income and UK Equities teams and director of Jupiter Asset Management Limited, Anthony Nutt currently manages 4 investment funds: the Jupiter Income Trust, Jupiter High Income Fund, Unit Trust, Jupiter Dividend and Growth Trust, and the equity portfolio of the Jupiter Distribution Fund. Since joining the company in 1996, Nutt has outperformed the UK stock market consistently. For example, between the launch of the £506 million Jupiter High Income Trust in February 1996 and December 2001, Nutt generated 316.07%, or 9.38% per annum. During the same period, its benchmark index, the FTSE All-Share Index, grew 159.93%, or 6.19% annually. Another notable fund that Nutt manages is the £2 billion Jupiter Income Trust. As of December 2001, he had generated 93.83%, or 5.83% annually, since taking over the fund on April 30, 2000. Its benchmark index, FTSE All-Share Index, grew 9.33%, or 2.88% per annum, during the same period. Value investment funds are widely available in the United States, but in the United Kingdom, the word value is not as often used to describe an investment product. Instead, the British prefer the words income or dividend. Anthony Nutt said, "I presume the term value is preferred in the US because many legendary American investors have written books about the topic. In the UK, value investing has actually been around for a long period of time, but we don't often say it because investing is all about seeking value in the first place, so it is unnecessary to add the word to an investment scheme." When looking for value investments, however, the British demand fund managers generate returns in the form of dividends or income. Be they conglomerates, consumer staples, or utility companies, British investors prefer a level of comfort through dividend payouts from companies, because they are the only tangible proof of investment returns. Nutt's life and career experiences may provide a hint or two that will help to explain Britain's investment culture. Born in 1953 in the Midlands, Anthony Nutt would be classified as a baby boomer in the United States. At the time of his birth, Britain was in a period of recovery following what Sir Winston Churchill called a period of blood, sweat and tears. Nutt recalled that people were extremely frugal in the 1950s with the rationing from World War II continuing. People added only a few items of comfort to their homes and led very modest lifestyles. The country had once pushed for peace and prosperity, only to see itself devastated by the European conflict. The experience taught people to look for tangible returns rather than bet on rosy assumptions. While growing up, I didn't have any dreams except I wished to work in the city, London, one day, said Nutt. In the mid-1960s, there was a movement toward distance learning and night classes, and it became apparent that you could get a university degree whilst working. I was interested in the program, so I enrolled at the Open University to study a wide range of subjects, including philosophy, politics, and economics. Working and studying in the early 1970s, Nutt was well aware of the uncertainty of the British economy. As high rates of inflation prompted the government to cap wage growth in the public sector, trade unions went on strike. Industrial action by coal miners, in particular, led to power outages across the country. The conservative government of the day responded to the crisis by introducing the 3-day week to reduce electricity consumption. In effect, working hours were shortened, and lights were switched off at a certain hour. Nutt recalled, I was living in Earl's Court in London, and the city became very quiet after dark. In addition to the 3-day week, there was an oil crisis in 1973, quickly followed by a string of bank collapses. NatWest Bank almost went bust, and the government had to inject liquidity into the financial system to rescue the economy. It was a difficult and transitional moment for the British people, including myself. Aside from school, Nutt worked with the Ministry of Defence, MOD, in the procurement executive. His duties involved overseeing the sale and purchase of arms. I must say it was an interesting time to be working for the MOD, Nutt said. However, the job was not particularly rewarding in terms of rapid progress or other attractions, except that I was allowed to continue working in the city. After a little more than 2 years as a civil servant, Nutt decided to move into stockbroking, joining Foster and Braithwaite, a well-known UK brokerage firm, although he remained there for only a short time. He explained, I worked in stockbroking for a total of 8 years. In those years I took a lot of qualification exams and learned about financial statement analysis and investment research. One day, I came to the conclusion that I wanted to manage money for a living. Since stockbroking is on the sell side, giving investment advice and executing trades for clients, I ultimately had to be on the buy side in order to manage money. Finding a job offering as assistant to a fund manager, I left stockbroking for good and joined the fund management industry. A Victorian mindset. After switching to the buy side in the early 1980s, Nutt initially worked at Family Assurance, an organization that manages money on behalf of what are known as friendly societies. Before there were insurance and welfare, people came together to form friendly societies so they could achieve common financial and social goals, Nutt explained. The friendly society concept is a very old Victorian concept which encouraged people to contribute their savings to the society regularly, and then, over a fixed period of time, they would receive a fixed return. Regular savings, spending below one's means, and living modestly were traditional values in Victorian Britain. Indeed, Charles Dickens advised the readers of David Copperfield, annual income £20, annual expenditure 19.6, result happiness. Annual income £20, annual expenditure £20.06, result misery. At Family Assurance, Nutt was delegated the tasks of analyzing stocks and looking for companies that paid dividends. After a while, he came to realize that an emphasis on dividend yields alone was a mistake. More crucial were the prospects and valuation of the business. Gradually, he became value-conscious in his investment analysis. Nutt commented, "You cannot compare dividend yields across companies and make a simple investment case out of it. You have to analyze the prospects of businesses and see if they can grow their dividends over time. With growing dividends, you get growing income, which effectively allows you to reinvest your capital so that you can have compounding effects for your investments." Since the stock market can be fanatical, business valuation is also important because better returns tend to be made with lower valuations, and over a longer period of time. From what I do now at Jupiter and even from my days as a stockbroker, I observed that in the UK, if you buy a stock at 30 times earnings, historical and empirical evidence have shown that over time its investment return will be more modest than if you buy a stock with only 5 times earnings. With considerable fund management experience under his belt, Nutt took on greater responsibilities and joined UK Provident in 1984. Just 2 years later, he moved to the Trustee Savings Bank, TSB, and became the official fund manager of the bank's £1.5 billion General Unit Trust. Managing one of the largest investment trusts in the United Kingdom, Nutt faced his first challenge as a professional fund manager. "My challenge was not the size of the fund, but rather I had to spend a tremendous amount of effort and time to sort out stock holdings in the portfolio that was handed over to me." Nutt explained that the small-cap boom of the 1980s had led the fund's previous manager to invest heavily in small companies. The origins of the small-cap boom dated back to the 1970s, when the British economy was in difficulty and many businesses went bust. As the economy began to recover in the 1980s, small companies with high growth prospects began to emerge. As they went public, they not only gave strong momentum to the stock market, but also led to a period of multiple expansion, as investors were eager to pay for higher-than-average P/E multiples. At the same time, large conglomerates were also contributing to the stock market rally, regularly making headlines for their purchases of smaller companies to maintain a high rate of growth. Nutt explained, "UK conglomerates were going around the world and buying up businesses. They rationalized them, cost-cut them, and improved their bottom line. Because these conglomerates were successful in buying companies, their high valuation was reflected in their stock price. And because of that, it became a self-generating investment model. They would continue to take over lowly valued businesses and add earnings to their income statements. Obviously, that model lost its charm after a while and investors lost faith in it. After October 1987, investors finally recognized that these conglomerates were playing an accounting game by maintaining their own high multiples by buying low multiples companies to increase earnings. With write-offs, write-backs, and one-time accounting adjustments, investors finally recognized that conglomerates weren't value plays at all. They were more of an operation based on accounting models and financial gearing. After taking over the fund at TSB, Nutt decided he wanted value stocks in the portfolio, rather than momentum or multiple expansion stocks, so he decided to cut down his positions in small-cap companies and other holdings. This decision proved to be a very sensible one indeed, not to mention timely, with the Black Monday crash occurring on October 19, 1987. Nutt recalled, in July 1987, the UK index topped out and over the summer it had a lot of volatility. While I was already skeptical about the market, my conviction to sell was further confirmed after listening to Financial World Tonight, which was a very popular financial radio program in the UK. Those interviewed on the program were starting to give poor investment tips and recommend speculative ideas, and it became apparent to me that there wasn't a great deal of value in the market. With the market becoming a bit gung-ho and stocks all priced according to blue sky scenarios, I not only tried to sell down on small-cap stocks, but I literally tried to sell down on stocks to raise cash. On the Wednesday before Black Monday, I managed to raise £200 million by selling our positions through a program trade. Then, on the Friday, we had the biggest storm ever in the country. No one could get to work, and the stock market was closed. Then Monday came and the market tumbled. The TSB fund was fortunate to be highly liquid at the time, Nutt explained, and was able to buy a number of undervalued stocks after the crash. Black Monday really gave me confirmation that value investing works, he added. It not only works for buying undervalued stocks, but also for selling overvalued ones before trouble happens. Stock valuations changed after 1987. The small-cap frenzy began to wane, conglomerates began to fall out of favor, P/E multiples reverted to their mean, and the Victorian concept of steady income gradually regained favor. As Charles Dickens put it, there is nothing so strong or safe in an emergency of life as the simple truth. Focusing purely on the quality of businesses and their valuation, Nutt took the general unit trust to the next level, and the fund began consistently to outperform its peers. Finding the right investment culture. Looking back at Black Monday and its aftermath, Nutt pointed out that the general investment landscape in the United Kingdom remained positive. Retail savings continued to power ahead as the Thatcher administration promoted investments through various programs, such as the Personal Equity Plans, PEPs. The PEPs program, introduced in 1986, relieved investors of income and capital gains tax up to certain annual limits. On top of PEPs, the government pushed for the privatization of state-owned enterprises throughout the 1980s, which encouraged every British citizen to participate in the stock market. If you look at the British market, it was generally bullish from the early 1980s to the late 1990s, Nutt said. For example, from 1982 to 1998, the FTSE index had an annualized return of roughly 13 to 14%. After Black Monday, the index took about 2 years to recover, but since then it had continued to reach new heights. Thanks to his stellar performance at TSB, Nutt was approached by Fleming Investment Management in 1989. After managing that firm's £2 billion fund for several years, Nutt joined Jupiter Asset Management in 1996, where he remains. Having now been in the fund management business for more than 30 years, Nutt believes that to produce a sustainable investment record over the long term, a value fund manager has to find an investment workplace that shares his or her value investing mindset. He explained, "You can't get away from the fact that the stock market is a casino in the short term. As it is a common paradox that long-term returns are achieved by short-term targets, you can't deny that many investment companies constantly aim for short-term results. I don't like to treat the market like a casino, so I'd rather focus on the long term and have a buy and hold strategy. At the same time, it is important to find the right investment company that thinks the way you do. When it comes to value investing, my investment team and I believe that the difficult part lies not in finding out whether a stock is cheap or dear. We can always look at a business objectively and come up with a fair opinion about it. The more difficult part is that we never know if other investors are identifying the very same stock and thinking the same thing as us. In essence, determining how long it takes for an undervalued stock to perform is totally out of our control. Because of that, we never have a time horizon for our investments. We focus purely on valuation instead. Sometimes we exit an investment when its business has become fully matured or its business return begins to deteriorate. Sometimes we hold on to an investment for years because its value remains attractive. Investment exit, then, is never a timing exercise, but a valuation one. Nutt cited the example of the technology, media, and telecoms (TMT) boom in the late 1990s, a period of excessive valuation during which a number of traditional stocks were trading at only 4 to 5 times P/E ratios. No one was interested in those old economy stocks because investors thought the internet was going to replace them. Although we had no idea when investors would become interested in those stocks again, we continued to hold them as they provided good returns. When the TMT boom turned to a bust, investors finally recognized how low the valuations of our stocks were. Nutt and Jupiter Fund Management's shared investment philosophy allows them to think for the long term and generate investment returns in a non-fanatic way. Launched in 1985, Jupiter was at first a specialist investment boutique. Over the years, it has fostered a culture that allows an entrepreneurial spirit. Fund managers are discouraged from being closet index trackers who passively mimic the returns of the stock market. Instead, they are encouraged to invest freely as long as the investment in question fits their fund's objectives. Without an in-house stock list or market view, individual fund managers have the freedom to make decisions independently. After all, Jupiter insists that a committee-based approach can lead people into a rather weak compromise that ends in mediocre performance. Based on its fundamental and bottom-up approach to stock picking, the company asks only that its managers optimize performance over the medium to long term without exposing investors to unnecessary risk. Nutt added, "When I joined Jupiter, it was emerging as one of the more successful retail investment houses in the country because its charismatic founders had established the right culture and business pace." Within just a few weeks of joining the company, I became responsible for the launch of the Jupiter High Income Trust. Whether you call it income investing or value investing, the underlying concept of the fund is to seek low valuation stocks that provide an upside and ensure the safety of investments. Trusting only tangible income. When attempting to identify investments, Nutt looks for undervalued businesses with a strong and sustainable cash flow. At the same time, he makes sure that these businesses have a standing commitment to distribute income in the form of dividends, special dividends, or share buybacks. Nutt explained, "The British culture encourages me to look for tangible returns rather than bet on blue sky scenarios. If you look at dividends alone, the UK leads the world in terms of high dividend payout ratios. I have seen many businesses that promise growth, but instead of distributing income to shareholders, they bet on a multiple expansion model. When the market falls out of love with this sentiment-driven scheme, these businesses have nothing tangible to offer shareholders." To find the right investment, You must look for businesses that generate sufficient return on capital and sustainable cash flow so that investors can be rewarded for their investment. In effect, paying dividends is a way to convince investors to remain invested in the business. As an example, Nutt cited a hypothetical opportunity to invest in a gold mine. You naturally expect to generate returns on your investment, so you give management the capital to develop the business. Then you expect them to monetize the gold mine and allocate resources accordingly. As management set aside capital for expenditures and business development, you also expect them to pay you back your invested capital. I think this is a very logical framework for doing business, but the problem is that many investors are never paid back because management often bets on the stock market to do the job for them by pushing their stock price higher. While taking a bottom-up, pragmatic approach to value investing, Nutt cautioned that looking purely at the numbers can be misleading. He explained, "We don't just look at the numbers or yields alone to make an investment decision. Although we analyze dividend yields, payout ratios, P/E multiples, return on invested capital, and free cash flow, we believe that looking at these numbers is too simplistic. While I subscribe to the idea that all roads lead to Rome, and whatever criteria you use to value a stock ultimately gives you an idea of what's cheap or dear, the more important aspect is qualitative analysis. Most of our analysis focuses on understanding businesses and their strategic intent. We spend each year looking at over 500 companies, and we get in touch with each company 2 to 3 times a year. To determine strategic intent, Nutt talks to companies' management teams and tries to understand their goals and aspirations for the business, and he applies Michael Porter's 5 forces to his analysis: threat of new competition, threat of substitute products or services, bargaining power of customers, buyers, bargaining power of suppliers, and intensity of competitive rivalry. Nutt elaborated, "We try to assess to what degree a business is plausible. Will it be able to execute its business model successfully? Is its management capable? If the business is good, can it grow its dividends over time?" These are some of the questions we ask. Sometimes I am uncomfortable analyzing a business that targets high growth, but at the same time we need growth in a business to ensure that it not only has the capability to pay dividends to investors, but also the capacity to grow those dividends over time. Whether or not there is growth, the key is to make sure that the valuation of the business isn't excessive and that you are not overpaying for growth. Many value investors like to invest in companies with no debt. For Nutt, however, debt is something of a distraction. It is not an unpardonable sin as long as it serves a good purpose. I like to see efficient balance sheets rather than worry if a company has debt or no debt because every situation is different. I've seen companies with cash-rich balance sheets, yet their business is poor. I've seen companies with high debt, yet their balance sheets are efficient. I think it is acceptable to have modest debt at a reasonable cost. As long as a company's management shows the strategic intent for it and proves that it can enhance shareholder value, then I support it. At Jupiter, Nutt holds 100 to 110 stocks in each of his 4 managed funds, with the top 10 holdings usually making up 40% of each portfolio. Always taking a long-term approach, a strategic shift to any sector weighting tends to be gradual. Because of the size of the funds, entering and exiting investment positions can take weeks, if not months. Investors sometimes blame Nutt for buying too early or selling too soon, but in the main they understand the difficulty of maneuvering investment positions that are large in size. As previously noted, Nutt is a bottom-up stock picker. Although the fundamentals of a business are most critical in stock picks, He acknowledges the implications of macroeconomic factors. He said, "I believe that or bottom-up analysis is always the main contributor to excess returns over time. But there is no doubt that macroeconomic policies have had great impacts on global stock markets over the past few years. By looking at these policies with a top-down view, my job is also to identify long-term business trends. Through picking the right sector, we think that good companies with varying degrees of success can do well in different economic cycles." When everyone else was throwing themselves into internet stocks, Nutt stayed well away, instead investing in the mining sector because its long-term prospects appeared favorable. After considering the implications of the internet for traditional businesses, he concluded that the world still needs food to eat and oil to power the economy. He explained, "We always look at the long-term impact of businesses." I still remember going to an analyst meeting at mining company Rio Tinto in 2000, and the CEO said that the demand for the company's products in China was something they had never experienced before. That was an important signal about the mining sector, but investors preferred to stay with internet stocks. When internet stocks went bust and investors began to invest in the mining sector in the mid-2000s, the story was not new to us. In 2007, however, Nutt decided to sell all of his positions in mining because the sector's businesses had begun to deteriorate, and their valuation had become too rich. Mining companies had a model of returning cash to shareholders in the 1990s and early 2000s, but when the sector became too hot, managements were reluctant to distribute capital to shareholders and decided to expand their businesses. By 2007, some of them almost went bust because of overexpansion. We sold some mining shares at the top of the cycle because they no longer delivered shareholder value. At the same time, we began to buy pharmaceutical companies because after staying out from the sector for more than a decade, they were finally delivering shareholder value with reasonable valuations and sustainable dividend yields and growth. We got into the sector too early and were criticized by some investors, but over the past few years pharmaceutical stocks have delivered good income for our funds, and their share prices have also performed well. All in all, I think the hardest thing for companies to do is to allocate capital efficiently. As investors, our job is to analyze how efficiently they employ capital expenditure and how efficiently they return capital to shareholders. Then we try to determine their optimum debt level and fair value for the equity portion. His observations of the market have led Nutt to conclude that one of the pitfalls in business today is over-reliance on management consultants or investment bankers, who are trying to take the lead role in traditional businesses. Because these professionals attempt to build businesses by focusing on financial gearing and short-term results to impress investors, they tend to lose sight of the long-term and of real business value. Nutt commented, "When you move people from investment banking roles to nuts and bolts type companies, they tend to be conceited and do things that are more exotic. I am very weary of these personalities because the market always cheers them on for their turnaround capability in the short term, only to notice later that they have destroyed shareholder value and damaged the long-term prospects of a once respectable business." The courage to keep going. Sir Winston Churchill once said that, "Success is not final, failure is not fatal, it is the courage to continue that counts." Looking back over his investment career, Nutt said that he has enjoyed every moment of his time in fund management. Whether his investment funds are having an up or down year, he never worries too much because his focus on value and dividends means that any short-term market volatility is safeguarded by periodic income. Then, as volatility evens out over the longer term, investments begin to emerge with good value. Nutt said, 2007 to 2008 was tough because some of our media investments were poor. The sector was not as robust as we had expected. That said, I think I haven't had a period when I felt awful about my investment decisions, because as a fund manager you need to have confidence in your decisions and avoid self-doubt. If you have doubts that become too overwhelming, and you can't take the challenge, then you shouldn't be in fund management in the first place. After all, seeking value is an enjoyable job because you go along with different companies, and as they progress, your investments progress. By focusing on the long term, you can go through economic cycles without worrying about long or short, black or white. You just keep going and see how your own investments perform. Nutt recently read an article citing a poll in which fund managers were asked whom they would choose to run their own money. Most gave the same answer, myself. Nutt commented, "Forgive me if I sound a little pompous, but I absolutely feel the same because I am confident in my ability. I feel that successful investing has much more to do with individual thinking than general consensus. As long as you have the right temperament and time horizon for your investments, I think you can trust your own judgment rather than others." The U.S. financial crisis in 2008 and the ongoing European sovereign debt crisis since 2010 have led Nutt to believe that the developed world will be somewhat static for the foreseeable future, growing modestly and moderately. What concerns me most is a potential compression of investment valuation. There will be fewer anomalies at the high end and low end in the stock universe, so value investors will have arguably less opportunity to make money out of deep value stocks in a way that's been done in the last 30 to 40 years. We are now also in a world where the rich and well-off have more than they need, so it is a vice to have conspicuous consumption and instant gratification. In that respect, I tend to stay away from the retail sector as I believe the world should return to a savings economy from the current spending one. In fact, I tell my kids to focus on value and never overspend. A keen cyclist and father of 2 sons and 2 daughters, Nutt tries to instill the value mindset in his family members. Investing, like cycling, is both an individual game on the micro level and a team exercise on the macro level. He concluded, "I am a frequent spectator of the Tour de France. One thing I have learned from cycling, which is also true of investing, is that whether you lead or you fall behind, it doesn't matter. It's all about having the endurance to finish the race and the courage to continue." Chapter 8. The Frequent Value Traveler. Mark Mobius. Templeton Emerging Markets Group. 2 roads diverged in a wood, and I took the one less traveled by, and that has made all the difference. Robert Frost. Mark Mobius is the executive chairman of Templeton Emerging Markets Group, a subsidiary of Franklin Templeton Investments. Currently managing the group's emerging market portfolios and overseeing an investment team that spans 17 market locations in Asia, Latin America, Africa, and Eastern Europe. Mobius was handpicked by global investing pioneer and billionaire Sir John Templeton in 1987 to manage the first emerging markets fund listed on the New York Stock Exchange, the Templeton Emerging Markets Fund. Starting with initial capital of $100 million, Mobius and his team have grown Templeton Emerging Markets Funds into a business worth more than $50 billion, as of the end of 2001. From its inception on July 31, 1989, to December 31, 2001, its flagship investment trust, the Templeton Emerging Markets Investment Trust, generated 2,071.5%, or 14.72% annually. During the same period, its benchmark index, the MSCI Emerging Markets Index, returned 866.4%, or 10.65% per annum. Often dubbed the Dean of Emerging Markets, or, more affectionately, the Yulbrynner of Wall Street. Thanks to his signature bald appearance, Mobius was one of Asiamoney's top 100 most powerful and influential people. In 2006, the magazine's editors wrote that Mobius boasts one of the highest profiles of any investor in the region and is regarded by many in the financial industry as one of the most successful emerging markets investors over the last 20 years. Despite tough times during the financial crisis 9 years ago, he still commands a strong following in the investment world and is influencing the direction of billions of investment dollars. After earning bachelor's and master's degrees from Boston University, Mobius obtained a PhD in economics and political science from the Massachusetts Institute of Technology, MIT. He is the author of 1 books, including Trading with China, The Investor's Guide to Emerging Markets, Mobius on Emerging Markets, Passport to Profits, Equities, An Introduction to the Core Concepts, Mutual Funds, An Introduction to the Core Concepts, and Foreign Exchange, An Introduction to the Core Concepts. Mark Mobius first became familiar with the stock market in 1973. While running Mobius Incorporated, a Hong Kong-based business consulting company, he was asked by a wealthy local client to conduct research on the stock market. As he had little investment knowledge, he reviewed market charts and applied technical analysis to his research. Mobius recalled, "At that time I had not learned about fundamental stock analysis. I picked up a book on technical analysis and I started analyzing the Hong Kong stock market movements. Having studied psychology, I liked the idea of technical analysis since it seemed to take psychology and particularly social psychology into account. Looking at market charts was also somewhat similar to conducting consumer surveys, which was my main job in the consulting business. My research led me to the conclusion that a very common chart pattern was forming. The head and shoulders formation. 1 Knowing that the stock market was red hot at the time and that its chart pattern signaled a trend reversal, I advised my client to stay away from stocks. The Hong Kong stock market did drop shortly thereafter and did not recover for many years. Before the tumble, however, Mobius failed to follow his own advice and put money into a stock called Mosbert Holdings. Mosbert Holdings was a Malaysia-based, Hong Kong-listed holding company. Although the company's background was mysterious and no one had any idea where its money came from, it kept making noise in the region by regularly acquiring companies and properties. When the company's stock dropped from $8 to $3.50, a colleague recommended it to Mobius, and they both decided to take advantage of the beaten-down investment opportunity. As it turned out, Mosbert was a scam, and the company soon collapsed. Mobius confessed, "I tried to do some due diligence by calling up the company to get some information, but the person who answered was unfriendly and said nothing was available in print. He even hung up on me. Going against my better judgment, I listened to my friend, who assured me that the company was to become Asia's next financial miracle. What I learned from this mistake was never to take other people's advice when making an investment decision. Always make decisions based on what you have learned and act on the information that you have gathered. Even if you turn out to be wrong, at least you can learn from your own mistakes." Another lesson that Mobius learned from the experience is that although technical analysis can be useful, fundamental analysis is more important because it is the only way to find out what a company is actually worth. In the case of Mosbert, The lack of available information should have told him to stay well away from it. I became a firm believer in getting out there and kicking the tires, and so fundamental analysis has become my primary focus. At Templeton, our investment team does look at stock charts, but we never make an investment decision without fundamental research on the company's financials, management, and industry dynamics. After carrying out more research on the stock market in the early 1970s, Mobius became increasingly interested in finance, and so he joined international securities firm Vickers da Costa in 1980 to conduct studies of financial markets in Asia. This was something of a career shift as he was a business and marketing consultant by training. Reading between the lines. Born in 1936 in Hempstead, New York, Joseph Bernhard Mark Mobius is the son of German and Puerto Rican parents. He reminisced, "When I was a kid, I first wanted to be a doctor, then I wanted to be in government service, and later on I decided I wanted to be an entertainer, either an actor or a pianist." In fact, when we were in high school, my brothers and I formed a trio, with me on piano and my brothers playing the violin and cello. In college, I played the piano in bars at night for fun, and the money helped to subsidize my education. Mobius received a scholarship to study fine arts at Boston University in 1955. Although the subject may seem somewhat irrelevant to a business career, it indirectly stimulated his interest in exploring the world. He explained, "Studying fine arts gave me a broad perspective on the human experience and our civilization. As I learned more about different cultures and how different people perceive the world, I became interested in communications and human psychology." After earning a bachelor's degree in 1958, Mobius decided to stay on at Boston University to further his education in communications, receiving his master's in 1959. His great thirst for knowledge not yet slaked, he then enrolled in the University of Wisconsin to study political science and social psychology, where he had an opportunity to take part in an exchange program to study abroad in Japan. Excited about the chance to travel to the Far East, Mobius embarked on a crash course in Japanese history and language before heading off. At the Institute of Humanistic Studies at Kyoto University, I learned about mass communications in Japan, he said. Because it was not too long after the Second World War, propaganda analysis was still quite the vogue in academic circles, and so I decided to specialize in it. While studying, I also worked at Asahi Broadcasting Corporation, where I researched the Japanese consumer market and sold broadcast time to American advertisers. Returning to the United States in 1961, Mobius studied experimental psychology and served as a teaching assistant at the University of New Mexico. During summer vacation, he also joined the advertising firm BBDO as a research analyst to process consumer survey data and analyze consumer and mass market behavior. Mobius's consumer data research alerted him to the booming economic development in different parts of the world. To learn more about economics, he enrolled at MIT to pursue a doctorate. At the same time, he also served as a research assistant there, analyzing survey data to reveal the characteristics of educational TV viewers. In 1964, Mobius received his Ph.D. Having achieved the highest academic qualification and having enjoyed his time in Japan, Mobius decided to move to Asia. Equipped with extensive knowledge of communications and psychology, his goal was to find a post that would allow him to connect businesses in the East and West. He joined International Research Associates in Tokyo as a consulting research coordinator, where his focus was on understanding consumer behavior in the region. Over the next few years, Mobius conducted thousands of interviews and analyzed more than 100 consumer brands from around the world. This opportunity not only afforded him knowledge of different types of businesses but also helped him gain in-depth insight into what would and would not work in the Asian business environment. For example, on one assignment, he was sent to Hong Kong to do consultancy work for Monsanto, a multinational agricultural biotechnology corporation, on the feasibility of distributing a new high-protein drink in Asia. Before he could advise the firm, he first had to understand consumer behavior and soft drink consumption in Asia, and then he had to analyze the production capability and distribution logistics of the area. Although his work could be seen solely as marketing research, it required Mobius to truly understand the value chain of the business before drawing a conclusion. He noted, "My consumer research experience provided a good background for what I do now because it involved social psychology, which ultimately affects business sentiment and the economy. It also taught me how to tackle and research an idea." Although I had no intention of becoming an investment fund manager at the time, my job gave me the confidence to analyze businesses and eventually to start my own firm. After the Monsanto project, the company offered him a job at the head office in St. Louis, Missouri, but Mobius decided to stay in Hong Kong, as he had grown fond of the city. His experience dealing with Asians of different cultures and developing the know-how to connect Eastern and Western businesses gave him the confidence to found Mobius Incorporated, a research-oriented business consulting firm in 1969. Thinking big and small. Starting out with a small team of local Chinese staff, Mobius Incorporated began to connect the dots. The company helped a Swiss pharmaceutical company set up a sales operation in Taiwan, assisted an American exporter in selling toilet soap additives in Indonesia, and conducted feasibility studies for a multinational dairy producer to determine whether a particular type of cheese was suitable for the Japanese market. Now his own boss, Mobius had to learn the art of consulting big businesses and running a small one. He recalled, "I was providing local intelligence to foreign companies to do big business in Asia, but had no idea how to run my own firm. I was constantly flying around Asia, and my revenues simply didn't cover my expenses. To make matters worse, I put in lowball bids for projects that wouldn't even cover my costs." Learning from my local staff, I eventually found bucket shops where I could buy discounted airline tickets, and instead of dining out, we ordered lunch boxes and ate in the office. Over time, I became frugal and value-conscious, and I came to realize that saving money can be more prestigious than making money. Becoming partly Chinese in spirit, I started focusing more on the numbers and being more conservative. I wouldn't say the firm became a cash cow over the next 10 years, but it became a stable business operation. Mobius's experience in Asia also inspired him to write a book in 1973. In Trading with China, he discusses the do's and don'ts of the Chinese marketplace. To spread the gospel further, he became a guest lecturer in marketing, social psychology, and consumer psychology at Hong Kong University and the Chinese University of Hong Kong. In the early 1970s, Mobius and his team found their niche in industrial market research. While building their Asian networks, they often came across unique business propositions. On one occasion they were offered the chance to distribute stuffed Snoopy dogs. Mobius explained, "One day, a woman from San Francisco named Connie Boucher walked into our office. She asked if we could find her a manufacturer to produce Snoopy dogs, for which she had a license from Snoopy's creator, Charles Schulz. I helped her out getting production going in Asia. When I saw how well her products were selling in the US, I asked whether she had ever considered selling them in Asia. She said, "Why don't you do it?" So we began distributing Snoopy dogs. Eventually, the toy business became bigger than our research business, and as my personal interest was in research, I sold the toy operation to my Chinese staff. There were two elements to Mobius's affinity with Snoopy. The beloved cartoon character made him a considerable amount of money, but a small accident involving the dog's stuffed incarnation also led to a more personal decision. Mobius explained, Snoopy dogs were overrunning our office, so I asked my staff to store some of them at my place while I was away in South Korea. On my return, I was awakened in the middle of the night by a strange smell, which turned out to be burning Snoopy dogs, as they had been placed near a heating coil. I managed to put out the fire, but not before my bright red hair was singed. As I'd already lost half of it, I decided to shave off the rest, and ever since I've quite enjoyed my new hairstyle. A Chinese saying has it that, of every 10 bald men, 9 are rich. As Hong Kong was quickly becoming an international trading and financial hub in the 1970s, with Mobius's business intelligence and new bald head, he was well placed to prove the saying true when he spotted an opportunity to provide clients with investment consultations. After analyzing the Hong Kong stock market for the aforementioned client in 1973, and having learned from his investment mistake with Mosbert Holdings, Mobius realized that in-depth research into companies' financials and management capabilities is key. Equipped with a thrifty mindset from running his own firm, the soon-to-be Dean of Emerging Markets gradually transformed himself into a value-oriented investor. In 1980, Mobius decided to sell his consulting business and analyze investments full-time. He joined international securities firm Vickers da Costa as a securities analyst. Primarily investigating the securities markets of Hong Kong and the Philippines, Mobius also carried out extensive research on the high-tech sector in Singapore, the oil sector in China, and blue-chip companies in Taiwan. In 1983, he moved to Taiwan to help set up Vickers's Taiwan office and became responsible for the research and development of emerging securities markets, including Korea, Taiwan, the Philippines, Thailand, Indonesia, and India. Now an expert in security analysis in Asian markets, Mobius received a life-changing phone call. Investing legend Sir John Templeton, a pioneer in global investing and the founder of the Templeton Funds, later Franklin Templeton Investments, had decided to explore Asia and other emerging markets, and who better to help him than Mark Mobius? Mobius officially joined Templeton as president of the newly launched Templeton Emerging Markets Fund in 1987. Trouble is opportunity. Sir John Templeton once said, "If you buy the same securities as other people, you'll get the same results as other people." Taking these words to heart, Mobius focused his energies on emerging markets in which typical investors hardly ever invest. Mobius explained, "John became my mentor in many ways. His investment philosophy blends in well with my understanding of human psychology and personality, because we both like to go to unusual places to unlock hidden value. For example, if my goal had been to achieve the same results as everybody else, then I wouldn't have taken the initiative to move to Asia in the 1960s and do something different." Another of Templeton's well-known pronouncements is bull markets are born on pessimism, grow on skepticism, mature on optimism and die on euphoria. The time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. John taught me to think for the long term, focus on the fundamentals, and think independently because the investment world has a herd mentality, Mobius elaborated. To achieve better results, I was encouraged to go against the crowd, but at the same time always analyze the situation before making a decision. John's approach matched my understanding of social psychology and my previous business experiences. Templeton, who passed away in 2008, also kept a plaque on his desk that read, "Trouble is opportunity." From his office in Hong Kong, Mobius traveled the world looking for investment ideas for Templeton. He later opened an office in Singapore and in 15 other countries, but he never stays in one location for long. Traveling more than 250 days a year, home for Mobius usually means a hotel room. I used to have an apartment in Hong Kong, but I sold it. I now own apartments in Singapore, South Africa, and Malaysia, but since I never really stay in those places for long, I rent them out and stay in hotels instead. I now call Dubai my home, but even then my stays there are short. In 1987, the Templeton Emerging Markets Fund started out with $100 million. Mobius began to load up on stock positions in Hong Kong, Singapore, Malaysia, Mexico, and the Philippines, the only 5 emerging markets that were open for investment in those early days. Then Black Monday arrived, and Mobius learned an important lesson in fund management: diversification. He explained, the Dow Jones Industrial Average dropped over 20% on October 19, 1987, Black Monday. The shockwaves reached Asia, and the head of the Hong Kong Stock Exchange decided to close the local market for 4 days. When it reopened, our investment positions were down by 1/3. Because we were so heavily weighted in Hong Kong, this was a real wake-up call. I certainly learned the truth of the old adage, never put all your eggs in one basket. In the years since, Mobius and his team have limited their investment exposure in any particular region or country. Further, within each region or country, they limit their exposure in any particular sector or company. We usually apply the so-called 5-40 rule, which means that the sum of our positions with over 5% allocation must be less than 40% of the overall portfolio. Also, we have an informal indicator, which is limiting any country-specific exposure to less than 20 to 30%. Once it gets above that, we watch our positions very closely. In line with this increased focus on regional diversification, over the past 25 years, Mobius has also broadened the breadth and depth of his investment radar. As of 2011, his investment team was spread across 17 locations, including Argentina, Brazil, Austria, China, Hong Kong, India, Malaysia, Poland, Romania, Russia, Singapore, South Africa, South Korea, Thailand, Turkey, the United Arab Emirates, and Vietnam. His team of 51 investment experts, who represent 26 nationalities and speak 24 languages, has collectively built a research database of more than 23,000 securities in emerging markets all over the world. Mobius explained, as we travel, we get new ideas about what's happening in different parts of the world. Sometimes those ideas lead us to our next investment or travel destination, but most of the time we have a very systematic way of generating ideas as we analyze the economic and financial data of different countries and companies from our database. It is important to realize that stock markets fluctuate and undergo booms and busts, but over the long term they reflect the economic growth and stability of their respective countries. The price-to-earnings (PE) ratio is a quick and easy way of making comparisons across emerging markets. Although Mobius and his team use it to screen for ideas, they are well aware that the ratio is useful only on a relative basis. For example, if a country has a GDP growth rate of 10% and a PE ratio of 10 times, It is certainly more attractive than a country with the same P/E ratio, but only a 5% growth rate. While considering companies, Mobius and his team also look at a plethora of other indicators, such as price-to-book ratio, return on equity, return on invested capital, profit margins, and earnings per share growth. Although sometimes our commentaries on economic growth, inflation, and other economic indicators make it sound like we are very macro-driven, I must clarify that macro analysis is just one part of our research. Ultimately, we are bottom-up value investors because we stress the importance of understanding the individual companies in our portfolio. After all, it is individual companies that are the components of our portfolio, not specific countries or regions, he further commented. Mobius also cautioned that a focus on the macro landscape holds the danger of becoming biased toward a specific region. We don't want to ignore good companies in bad economies. Sometimes we like troubled economies that are in financial or political distress because they spell opportunity. In essence, we look for the next big crash in emerging markets because in value investing, money is made after the crash, not before, so we don't mind seeing crises or downturns. First, we are mentally prepared for them, and, second, we don't mind them affecting our short-term performance because we are here for the long term. Over the years, Mobius has come to delegate much of the fundamental analysis to his investment research team. A more important role for him is to focus on the qualitative aspects of businesses, which means numerous company visits and meetings with management. I respect investors for crunching numbers and then buying and selling stocks based on their financial models. This method, however, only works when there is a sophisticated and transparent accounting system. Nevertheless, deep knowledge of the management is needed, Mobius explained. When it comes to emerging markets, you cannot rely on the numbers because they cannot be entirely trusted. You have to go out there and start kicking tires. Then you have to talk to company management, look into their eyes, and determine whether they are reliable. They may say their employees are happy, but sometimes you have to visit the company and talk to competitors to see whether that's really the case. Otherwise, the numbers that you input into your financial model are no better than what computer geeks call garbage in and garbage out. Of course, Mobius brings more than his evaluation of company quality to his investment team. The team also benefits from his long experience. Based on his business acumen and insight, his job is to balance and maintain a broad perspective on different markets from a historical, current, and future view. As regional investment specialists tend to favor their own regions, Mobius requires them to take a step back and compare their investment findings locally and regionally. His duty, then, is to ensure capital goes to the right market at the right price and the right time. I tell my people always to focus on the long term in their analysis because there are always hot stocks in emerging markets that are either unsustainable in the long run or that turn out to be scams. Our aim is to compare companies, regions, and countries objectively without fear or favor, Mobius said. Because their minimum holding period for an investment is 5 years, Mobius and his team have the stomach to tolerate wild market swings. All markets are fundamentally cyclical. Because emerging markets are somewhat immature, people get overly bullish and bearish all of the time. By focusing on value, we get in when everyone else is trying to get out. Also, our value discipline lets us compare different markets to see which ones are overpriced, so by the time everyone is trying to get in, we are getting out. Mobius added, when we look at an investment, we evaluate the company's records for the past 5 years, and then we project its business for the next 5. Because emerging markets technically start from ground zero, things can change quickly. So even if you try to project a business beyond 5 years, your analysis is likely to become a little vague. However, our holding period of 5 years leaves us room for market volatility in between. Obviously, there are times when our investments drop after our first purchase, but if we feel confident about the business and its management, then we don't mind buying more as it's on its way down. Over the years, we've had a lot of experience with bad weather and rough rides during our travels and company visits, but most of the latter have stemmed from the discovery that company management is cheating shareholders. Such experiences are difficult, but as a result we have become better judges of people, and better investors. Even in-depth research is not always enough to combat the vagaries of human nature, Mobius said. When we are cheated, there is not much we can do except to learn from our mistakes and move on. People say emerging markets are dangerous places to invest, but Bernie Madoff operated in the US for years. My belief is that there are good and bad people in every country. All you need to do is to keep an open mind, do your homework, and believe that the world is getting better each day despite the crises that occur from time to time. Feeling the market. Mobius has developed 4 cardinal rules for investing in emerging markets. Fair, efficient, liquid, and transparent, which form the acronym FELT. By a fair, Mobius means that one must make sure that the prospective emerging market treats its investors, both big and small, equally. Efficient means determining whether the stock exchange and local brokers are honest and friendly to investors and charge them at competitive and acceptable rates. Finally, an attractive emerging market will have the liquidity to place buy and sell orders on stocks, and these stocks will be characterized by accounting and financial transparency. Mobius explained, I have seen stock exchanges that are unfriendly to investors. I have walked into stock exchanges that have only a few people, and the same people operate the stock brokerage next door. I have dealt with dishonest brokers, and been in situations in which we couldn't exit our holdings because of illiquidity in the downward market. And I have seen accounting reports with fake numbers. So, again and again, I stress the importance of visiting companies and sizing up the situation firsthand. In a nutshell, Mobius believes that there is no simple formula for successful investing. There are no blueprints, no guarantees, and certainly no holy grail. There is, however, the right attitude that leads to better investing. He said, one important thing I learned from John Templeton was humility. By being humble, you are more open to new ideas and can be more objective in your investment research. With an open mind, you can accept that the world changes and that you must constantly learn new things to keep pace with it. What keeps me going today is my passion for investment research. It allows me to research the world, which leads me to understanding the meaning of life. To be a good investor, you need to open up your mind and be ready to accept whatever the world has to offer. Given the non-stop travel their work requires, the Franklin Templeton Group decided it would be safer, particularly given some of the unusual places Mobius needs to visit, cheaper, and more efficient for him and his team to travel by company jet than to take commercial flights. Since the 1990s, Mobius has traveled in style, though he also flies commercial if it is more convenient. He commented that, the company jet has made us more efficient because we can cover more places faster and also discuss investment ideas together on the way to company visits. It also gives us greater security. As for jet lag, I don't suffer from it anymore because my body clock has no idea what time zone is home. Mobius's wide experience of the world allows him to collect local intelligence quickly and smoothly in new locales, because he is open to talking to anyone at any time. Having seen the best and worst of emerging markets, he does have some concerns. What I dislike most is when I go to a new place and see a lack of laws and regulations that could improve the market and people's lives dramatically. In some cases, there is a need for greater regulation, and in others, less. Greater regulation is needed to improve transparency, but less to promote it, Mobius said. He explained, as the investment world is converging in the sense that people are becoming more global in their investment patterns, transparency is becoming increasingly important because investors depend on accurate corporate reporting to evaluate companies. However, I don't see the bureaucracy and politics of different countries changing dramatically in a way that will improve transparency anytime soon. I do hope that through my involvement in these markets, I can encourage them to improve their market structure one step at a time. In the meantime, we will not change our investment research approach, although we may change the way it's carried out. Always at the frontier of new emerging markets, Mobius is a unique value investor who brings something beyond analysis of the numbers. As head of the Templeton Emerging Markets Group, he sees his role as monitoring the winds of change in these markets, as he eloquently explains in his book Passport to Profits. Things change. The important thing is to remain, as a manager, as a messenger, as an investor, fluid and flexible. Markets, like the ocean and tides, are a wave phenomenon. The only way to stay on top is to bend your knees, keep your balance, and surf. Like surfing, riding the waves of the global market can be a blast. Not to mention incredibly profitable. But what we look for consistently, as part of our fundamental analysis, is a company's, a country's, a region's, and a management's capacity to manage change. The head and shoulders chart formation signals a price reversal from either a bullish or bearish trend. Chapter 9. The Value-Oriented Businessman. Teng Jik Lien. Target Asset Management. Experience is not what happens to a man, it is what a man does with what happens to him. Aldous Huxley. Teng Jik Lien is the founder of Target Asset Management Pte. Limited, a long-only investment management company established in Singapore in 1996. The company's flagship Target Value Fund, which invests mainly in Asia ex-Japan, grew from $5.5 million at inception to $2 billion in July 2010, when Teng announced his retirement. From September 1996 to November 2010, the fund returned 892.44%, or 17.59% per annum. During the same period, its benchmark index, MSCI ACFE, All-Country Far East ex-Japan, returned 81.27%, or 4.29% annually. After celebrating his 60th birthday, Teng wrote in his retirement letter in July 2010 that he wanted to take a short break to attend to personal matters, and to think of ways to practice fund management in a less stressful manner. After a year of relaxation and brainstorming, he came out of retirement in June 2001 and relaunched the Target Value Fund with a smaller initial fund size of approximately $500 million. His objective is to again pursue higher returns and lower risk by applying his time-tested value investing principles. Before one can properly determine the valuation of a stock, it is necessary first to determine its business quality, Teng Jik Lien explained in a discussion of his investment philosophy. An absolute low stock price has no meaning if one does not consider its business quality and compare it against its peers. Buying a stock at a low price and subsequently selling it higher without considering its business quality is really just Value trading, not value investing. A Malaysian-born Chinese who has lived in Singapore since 1985, Tang believes that the art and science of value investing is skewed more toward art than science. The ability to identify and evaluate a business is the most important part of the battle. Once you are able to understand its business model, identify its critical success factors, and determine its competitive strength or weakness, financial analysis and valuation become much easier, he said. A businessman turned fund manager, Tang has the capacity and credentials to talk business and investing at the same time. He believes that being a good value investor comes down to a thorough business understanding and a diversity of life encounters and business dealings. Tang certainly fits the bill. Learning the numbers. The son of a wooden clog maker and the sixth of 7 children, Tang was born in 1950 in Dungun, a coastal district in the Malaysian state of Terengganu. Growing up in a politically unstable environment in which economic policies were constantly changing, he faced many hardships. Because of my poor family background, at a young age I told myself that I had to get out of poverty, Tang recalled. It was no fun being poor. I was determined that however hard I had to struggle, I had to earn a good living one day. I looked around and saw that most rich people were in business, and so all I wanted to do was to become a businessman and make myself rich. Forced to leave school at the age of 18 to earn a living, Tang worked part-time at a mining company, a timber plantation, and an accounting firm. Learning business concepts at these jobs and taking night classes in accounting, after 4 years, he had saved enough money to attend college part-time in the Malaysian capital, Kuala Lumpur. He worked as an accounting clerk during the day and attended college at night until he was able to qualify as a chartered, certified accountant and a chartered secretary. In 1973, Tang joined the Guthrie Group, one of the leading British-owned conglomerates in Southeast Asia, as a branch accountant. The group was engaged in oil palm and rubber plantations, property development, manufacturing, chemicals, and consumer goods trading, affording Tang the opportunity to get a taste of all of these businesses during his decade in its employ. Elaborating on his decision to join Guthrie, Tang noted that his plan had always been to start his own business, but because he had married young and had 2 small children, he had to earn enough money to raise his young family and service his mortgage debt. The rational decision was to work for a large corporation, especially as Malaysia was still an emerging market in which the employment situation could be unstable at times. Climbing the corporate ladder over the next few years, Tang became chief accountant of one of the group's subsidiaries before being promoted to financial controller and then to chief financial officer of the overall group. Because of my senior financial position, I was required to have a good understanding of the group's diverse businesses so that I could analyze their performance. The areas I had to analyze included marketing, distribution, logistics operations, inventory management, and accounts receivable management. By using different financial models to evaluate and project businesses, I made recommendations to the company's board on capital and resource allocation, Tang explained. In the process, I was never afraid to ask questions. I would find out who was the most capable person running each division, and then I would befriend him or her and learn how he or she handled the business. Occasionally I would also share my ideas with these individuals based on my evaluation of the business. From a company's perspective, the accounting division is a cost center. As an accountant, Tang felt that he was more like a housekeeper, and hence his career prospects would be limited. After becoming financial controller, he realized that he could in fact make money for the firm. By managing the group's foreign exchange and sourcing the best financing terms, he slowly became a profit center. For these contributions, he was paid good bonuses and even rewarded with a company car. Gradually, Tang became interested in the financial market. In the early 1980s, the financial community in Southeast Asia was relatively small. Not too happy with the region's business environment, Tang decided to go to Australia to look for opportunities. In 1985, he decided that Southeast Asia was his home after all, so he returned. Rather than return to Malaysia, however, he moved to Singapore, where he joined the publicly listed WBL Corporation as financial controller. Moving to Singapore with my family was exciting because the country was becoming a financial hub in Southeast Asia, and its economic and political prospects were the most promising in the region, Tang said. In this much more sophisticated financial market, I had the opportunity to deal with top investment bankers and network with a more international community. Founded in 1906, WBL is a Singapore-based multinational conglomerate that operates throughout Asia. As it had a considerable amount of cash and several old economy businesses in the 1980s, the group decided to diversify into new growth industries, such as computer and component manufacturing and agricultural technology. Joining the conglomerate allowed Tang to learn about its main businesses, which included automobile, heavy machinery, and equipment distribution. In addition, he was given the task of managing the abundance of cash that the company had accumulated over the years. Applying his financial skills, Tang traded foreign exchange, fixed income, and equity for the company. By the end of the 1980s, WBL had deployed most of its surplus cash into its new business ventures. Now having fewer investment responsibilities, Tang decided to move on. In 1990, he resigned from WBL to become managing director of Morgan Grenfell Investment Management Asia, a leading London-headquartered investment bank. The art of contrary thinking. Tang's relationship with Morgan Grenfell dated back to the mid-1980s when he represented WBL in placing investment trades. He recalled, "After I had dealt with the investment team at Morgan Grenfell for a while, one of its executives told me that if I ever thought about leaving WBL, I should consider joining them. I think they were probably impressed by my contrarian approach to investing, especially after they saw how I made investments during the pan-electric crisis in Singapore in late 1985, when I bought many beaten-down stocks while others were panicking." Pan-Electric Industries was a Singapore-based company specializing in marine salvage work. When the group collapsed in 1985 due to unsettled forward contracts and related party transactions, it had 71 subsidiaries and a connection to virtually every facet of the Singaporean economy. It was wiped out overnight, forcing the Singapore Stock Exchange to close for 3 days. The crisis was unprecedented in Singapore, and remains so to this day. "The event was my first taste of a crisis," Tang explained. At the time, stocks were quite inflated, and Pan-Electric was really the trigger point that caused them all to tumble. Somehow I was convinced to enter the stock market because I had done my research on many companies for a long time, and they finally represented a good buying opportunity. I believe my strong conviction was due to my experience in handling different kinds of businesses over the years, which had gained me the insight to tell which businesses were good and bad and whether they were selling at a discount. Moreover, my accounting background also gave me the know-how and discipline to analyze business sensitivities. When even my worst-case scenario assumptions convinced me to buy, I had to trust my research. Tang was further encouraged by something Benjamin Graham wrote in The intelligent investor, you are neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right. Indeed, Teng was proven correct. Although Singapore's stock market dropped 20% after the panic in November 1985, in 4 to 5 months' time, it had recovered all of its losses and even begun an uptrend to gain more than 30% a year later. Teng believes that his accounting background has taught him to be conservative when conducting investment research. Therefore, when downside risk is carefully analyzed, the upside naturally takes care of itself. This mindset warns him against excessive optimism in any business because market cycles come and go. Another contrarian decision witnessed by Morgan Grenfell's investment team was Teng's decision to sell all of his Japanese stocks in early 1989 when the Nikkei 225 index reached 31,000 points. His rationale was that Japanese businesses were priced at extremely optimistic levels. Not being at all greedy, he was satisfied with his investment returns and happy to let go. The index reached its peak at 38,900 points in late 1989 and then tanked the following year, falling by more than 50%. On leaving the corporate world and entering the investment world, Teng commented, "Despite how much Morgan Grenfell's people liked me, I still had to convince them that I was the right person to take the job. I told them that although they could search for other good investment professionals, it would be difficult to find a person like me who also had experience in business development capabilities. I said that with my business experience and knowledge of investing, I was confident that I could develop new investment products more quickly than other qualified investment professionals. Thankfully, they were convinced by my arguments." Indeed, shortly after joining Morgan Grenfell, Teng brought fresh business insights to his team. "Our team wanted to build some investment funds with popular Asian themes, but we had no track record. Instead of going mainstream and directly competing with the big fund houses, we had to be different. I proposed the idea of launching emerging market funds in which other fund houses had no track record. That way, when we became recognized, we could reintroduce some mainstream products to the market." Teng's boss took his business proposal seriously. In the next 3 years, he and his team started funds in Korea, Pakistan, Indonesia, and China. Well received by investors, some of these funds grew from $80 million to more than $600 million in just a few years. Looking back, Teng acknowledged that investment know-how is only one aspect of the fund management business, and superior investment performance does not necessarily translate into successful fund management. To run a sustainable investment operation, another critical success factor is the capability of business development and management, which can range from raising capital to managing people, marketing the fund, and retaining investors. In 1993, Teng's immediate boss, Sifu Hua, the head of Morgan Grenfell Asia, fell out with the London head office, prompting many senior management staff, including Teng, to resign. He recalled, "I was quickly headhunted by UBS Asset Management, East Asia, while my boss, Mr. C, and several other colleagues went on to start Prime Partners Group, an investment banking company. In 1994, I left UBS and joined my ex-boss at Prime Partners." The following year, Teng was presented with a once-in-a-lifetime opportunity. The Monetary Authority of Singapore changed the regulations on investment advisory bodies, lowering the requirements for starting an investment fund. I said to my boss and my wife right away that I must start my own business because being my own boss had been my childhood dream. Already 45, my age, my investment knowledge, and my business experience all gave me a competitive edge. I knew that if I could build a nice performance record over the next 3 years, something good would happen. In 1996, Teng established Target Asset Management with total assets under management of $5.5 million. Targeting good businesses in Asia. Searching for value with the eyes of a businessman, Teng's main objective has always been to find good companies at reasonable prices. Given Asia's dynamic political environment and cultural diversity, Teng cautioned that investors must carefully assess the risks and opportunities in different Asian markets before making any investment decision. He explained, "Understanding politics is important because a change in political power can lead to a drastic change in economic direction. Because the political systems in many Asian countries are still young, risks and opportunities come and go very quickly. The economic cycle is also much shorter in this region, and market volatility is much greater than that in mature economies. In addition to understanding the characteristics of the Asian market, it is also important to understand the mindset of businesspeople in this part of the world." Reviewing the Asian business environment, it comes as no surprise to find that smart Asian businesspeople are very alert to which way the political wind is likely to blow, and to the next business opportunity. The smart investor needs to differentiate between those getting into a new business for business reasons and those doing so for political reasons. Sometimes it is the businessperson's network and entrepreneurial skills that drive the business rather than the nature of the business itself. In addition to politics, culture is a concern. Teng noted the diverse cultural characteristics of the region's Chinese-speaking people alone. For example, due to the different political environments in which they live, Hong Kong and Taiwanese citizens generally tend to have a lower risk tolerance than their mainland Chinese counterparts. When it comes to tastes and preferences, even within mainland China, there can be tremendous diversity. For example, different parts of China have their own dining cultures. When evaluating a food and beverage business, then, what works in northern China may not work in the south. Teng said, "I spend most of my time trying to understand businesses, identify their success factors, and examine their operational capabilities. Particularly with small and medium-sized businesses, I like to dig into their operational details such as their distribution logistics, branding and marketing strategy, and financial and cash flow management. For example, sometimes I ask management how they deal with their company's stock obsolescence, and if they cannot or refuse to answer the question, or if they spout back a bunch of nonsense, then I would rather stay away from them irrespective of how attractive the business is." When investing in Asia, many investors focus on the region's growth potential. Beyond focusing on the numbers and statistics, such as a business having 5,000 distribution channels and the capacity to expand into 2,000 more, they must also understand how the business works. For example, what makes the business tick? Why do consumers want its products? What is the right price structure for those products? What is the contingency plan if the products do not sell? These questions must be asked even before the business is valued. Thanks to his business acumen, Teng focuses on asking the right questions because he knows that in the Asian industry landscape, a well-defined business model and management quality are key. In fact, an investment valuation can be accurate only if these important business issues are identified and addressed. Teng explained, because Asia is a fast-growing region, and there is an abundance of business opportunities, many entrepreneurs become overly ambitious and distracted from their core competence. Also, there is a large corporate governance risk, as legal regulations are not properly enforced in the region. It is therefore very important to have a good network to check the background of these business people, particularly those who have a very short business history. He added, in fund management, you cannot look at only one dimension of a company. You also cannot look at a single company and say that it is a good company. If you look at only one company at a time, then you are as good as blind. You must make relative comparisons. After all, how do you know a business is good if you do not compare it with others? You must consider the market dynamics and the different characteristics of a business. Here in Asia, even if you find the right industry, you might still lose money. You often have to look into an industry's food chain to see who calls the shots and who owns the sweet spot. Teng gave an example of how a top retailer in Hong Kong was doing good business, but it still had to close down because the landlord kept raising the rent. Customers were lining up in front of the shop, and it still had to close down. What does that mean for the investor, he wondered. The relativity of valuation. As the saying goes, a good business may not necessarily be a good investment, and a good investment may not necessarily be a good business. Picking a good business is Teng's priority, but when a good one is spotted, investment valuation comes next. Teng said, "We are given two eyes, one for the upside and the other for the downside. When it comes to valuation, we must first distinguish which growth phase a company is in, and then play with its upside and downside sensitivities. If it is in a high-growth stage, then value comes from the company's prospects, but if it is a no-growth company, then value may come from its share price discount. Value is relative. When I do my quantitative analysis, I do not have strict criteria regarding the numbers, such as the P/E ratio has to be less than 10 times, return on equity has to be over 15%, or the debt-to-equity ratio has to be such and such. I think a sensible investor has to take into account the characteristics of a business, the economic conditions, the investment environment, and valuations among different potential investments. Flexibility is the key, and it requires experience. Teng has no objection to buying businesses at the forefront of the new economy as long as they show proof of generating real cash flow. It just takes a bit of foresight and imagination. Without real cash flow, good businesses are nothing but good concepts. Teng believes that the goal of value investing is to find undervalued opportunities. The problem, however, lies in defining undervalued. Does an investment have to be undervalued when the investor buys it? Or can it be undervalued in a year's time if the investor has the vision to buy it today? I quite often say to investors that despite being a value investor, I do invest in high P/E stocks if the high P/E is due to a passing business phase or a short-term mishap that is unlikely to recur, Teng elaborated. We like to buy into fallen angels or companies going through necessary growing pains before their earning potential is developed. It is like buying an ugly caterpillar that eventually becomes a butterfly. Being able to make such an investment requires a lot of in-depth research and a good understanding of the business and its industry dynamic. Teng believes in the value investment strategy developed in the West, but recognizes that it requires adjustments for application in the East because of the highly volatile nature of the region's markets. He explained, while emerging countries have higher growth, they also have greater risk in terms of politics, corporate governance, the shorter business cycle, and less liquidity. A market correction in an emerging economy can easily mean 20 to 30%. Which is equivalent to a crash in a developed market. Because valuations on stocks can swing wildly, a long-term buy-and-hold strategy without due regard to market volatility can lead to underperformance. This is not to say that one should actively trade the market, but it is wise for investors to make a profit when the market is euphoric or a stock has reached its full valuation, and then to buy again when the market corrects. Teng tends to invest in fewer companies, concentrating on surer bets and devoting more time and his expertise to businesses that he knows well. At any given time, his portfolio consists of roughly 30 stocks. Contrary to the popular adage about never putting all of one's eggs in one basket, he believes that it is easier and better to put most eggs in one basket, and then watch that basket. A concentrated portfolio allows a fund manager to remain focused, which makes his or her work easier. Teng joked that making the decision to own a stock is to him as serious as saying "I do" in a marriage ceremony. He thus makes a solid case to himself each time he drops or adds a stock to his investment portfolio. He explained, "If a stock in the portfolio drops, what concerns me most is whether it has fallen along with the broader market or whether it has fallen against its sector. It is natural to fall with the broader market, but if it falls against its peers, then this means the market has concerns about this individual company. I would drill right into the reasons and find out why. Sometimes, a stock gets sick for different reasons. If it has only caught a cold, then it may be an opportunity to buy more and average out, but if it has terminal cancer, then I have no hesitation in cutting the stock out right away. Because my strength lies in evaluating businesses, I am not affected by the noise in the market. What I care about most is whether the drop is due to normal business issues or business structural changes." A value lifestyle. Growing up in a low-income family, Teng learned to be frugal at a young age. Over the years, he has learned to make sure that whatever he buys constitutes value for money. He stresses the importance of making comparisons before any purchase, whether for an investment product or anything else. Indeed, looking for value has become a way of life. In 2006, when office rents in Singapore began to rise, Teng looked into buying his own office. Instead of aiming for a prestigious location, he compared prices and found a bargain just a few minutes away from the fancy commercial buildings in the central business district. He turned an attractive 3-story conservation shop house next to restaurants and fashion boutiques into his fund house. The property's value has gone up tremendously since his purchase. Teng said, "Shopping and investing are similar. They are really about common sense, but somehow common sense seems to have become quite uncommon. Sometimes, good deals and good ideas come from talking to different people, and then the next step is to think more deeply about those ideas and how they interconnect with our society and economy. When we think hard enough, we sometimes get a sense of what is happening around the world." He cited the Asian financial crisis of 1997 as an example. "When everyone in the world was praising Asia, I made a conscious effort to sell down Asian stocks because they were quite inflated in the first place. Moreover, many business deals in the region were a matter of ego and ambition. 3 deals in particular set off alarm bells. The first one was when Malaysia decided to build the world's tallest building, the Petronas Twin Towers," Teng recalled. The second was when Malaysia and Indonesia had talks about building a bridge to connect the two countries, which would have cost billions of US dollars. The third was when many booming Asian cities were flooded with millions of illegal immigrants all taking part in the frenzy. "I could not tell when a crisis would hit, but I knew something was not right." Managing to duck the crisis, Teng's investment fund dropped only 15.74% in 1997 when its benchmark index dropped 44.31%. Then, in 1998 when the index dropped 4.82%, Teng generated 61.8%. Although common sense saved Teng from danger, it did not ease the pressure placed on him during the internet boom and bust. When my clients said how old-fashioned I was for not taking part in the new dot-com economy, I had a second of doubt about whether my investment knowledge had become obsolete or the world had really gone through a structural change. Then I thought more about it and realized that internet companies were no different from non-internet companies. They still had to pay tax, interest, salary, rent, and other expenses. Yet they made no real cash. Indeed, Teng's sensible attitude and good judgment allowed him to generate a 1.44% return in 2000 when his fund's benchmark index dropped 36.73%. Moving forward to 2008, the global financial crisis presented Teng with his first real challenge. Following the collapse of Lehman Brothers, even common sense could not protect a long-only value fund. The fund outperformed its benchmark, but it was still down by 44%, Teng said. As a value investor, I knew stocks were cheap, but I could not tell when the world would turn around. I wrote a special letter to my investors, telling them that I would personally inject $10 million into the fund to support my buying thesis. When the worst was over in 2009, the fund was up 68%. Hitting the 60-year mark in 2010, Teng decided it was time to slow down. He closed down his fund in November of that year, but decided to reopen it just under a year later. I am just too addicted to investing. It is a way for me to learn and understand life, and it is a way for me to appreciate our vibrant world. Relaunching the fund, I wanted to keep the fund size at about $500 million and to limit it to fewer clients. I still enjoy running money, but I want to do so in a less hectic manner, he explained. A value manager who has never subscribed to Bloomberg or Reuters, Teng does not believe in keeping up with minute-by-minute changes in stock prices. After all, value investing is about buying good businesses, and stock price fluctuations have nothing to do with it. In support of the value lifestyle he leads, Teng concluded, "Our globalized economy has made the world move faster and closer together. Because capital flows around so quickly, diversification is not necessarily going to reduce risk. What matters then is how the investor applies the value investing framework to find good businesses that are sustainable enough to survive any crisis."